Okay. Good morning, dear friends. Welcome to the second session on Ind AS 102. And please download. The material is the same. That is what was given day before yesterday. And we had commenced Ind AS 102, wherein we discussed in principle how to account for employee stock options. That was the principle. And we also saw how does my vesting conditions, how are my vesting conditions accounted for. We did a couple of problems wherein we saw spreading of the cost of the options depending on the options that are likely to vest at the end of the vesting period being spread in a straight line basis over the vesting period. So this was a vesting condition being a service condition that was accounted for. Now, today's class, we will be having lot of concepts to cover, and we will also now today from the first problem onwards, we will now check how to account for performance conditions. What are performance conditions? Performance conditions are essentially a service condition that has also a target or a performance target to be achieved. Merely completing the service condition will not entitle you to the options. You have to complete the service as well as achieve the performance target. When you do both these things, at that point of time, you can say that you have met the vesting conditions, and therefore the options will vest in you at the end of the vesting period. Now, your performance conditions we discussed could be of two types. They could either be a non-market condition or they could be a market-based performance condition. Non-market condition could be like, for example, achieving increase in sales or achieving a reduction in cost, or it could be achieving a level of earnings before interest and taxes. These are the performance conditions that are inbuilt when I design the option plan. So how do I account for these conditions? The non-market based performance conditions would be accounted based on estimates. It would be accounted based on estimates. What is the likelihood of this performance condition being met? I will estimate that. That estimate will affect directly the number of options that are likely to vest. That estimate will, directly have an impact on the number of options likely to vest. And therefore, I have to do this estimation at the end of every reporting date. As on the reporting date, I will have to make an estimate. Based on the facts that have come to my light, I will have to make an estimate. And I will have to take that cost on a straight line basis because it is a performance condition along with a service condition. So we saw service condition, divide the cost over the vesting period on a straight line basis. Here also the same thing is there. Additionally, what you will do, you will estimate the likelihood of the non-market based condition to be met. So this is what is your concept that will be there. We will check the application of this concept based for a few examples. Now, some of the examples are drawn from your study module. So they will be done in a simple fashion. The entries are clear to all of us. First entry will be employees benefit expense account debit to share-based payment reserve. Why reserve? Because what I am issuing is equity. So we will come to the questions now to understand how these options will be accounted for. All right. So I hope the screen is now visible. Let us come to illustration 7 of your study module. The entries, all these items are there. I will only explain the calculations, okay? Because that is what is important for us. We save time, I can cover more concepts. Important to notice, this question has a similar type has been asked in November 18 as well as May 2019 examinations for 8 marks each. So therefore, it is exam probable, I cannot say that, but yes, it has been asked in the exam. It is easy to answer. We must get all the marks that is attributed to this, what you can say, to this chapter. In fact, if I have to comment in the terms of an option, in terms of this performance conditions, if the institute gives us the option of this question, we have to perform such that the marks attributed to this question vest in us when I complete the paper. So that should be our attitude when we are approaching Ind AS 102. All right. So let us come to illustration 7. We'll read the problem. Ankita Holding Inc. grants 100 shares to each of its 500 employees on 1st January X1. The employees should remain in service during the vesting period. The shares will vest at the end of the first year if the company's earnings increase by 12%. So if in the first year your company's earnings, that means profit, increases by 12% over the previous year, then the shares will vest at the end of 1 year. So you will check whether it has been met at the end of the first year. If not, then go to the second condition. The shares will vest at the end of the second year if the company's earnings increase by more than 20% over the 2-year period. So you will check what has happened in the past 2 years. If it has increased more than 20% over the 2-year period, then the shares will vest at the end of the second year. So what you will do at the end of the first year, has it met 12%? The answer is no. Then you will say it is likely to meet 20%. So you will now increase the vesting period to 2 years and then attribute the cost accordingly. The shares will vest at the end of the third year if the entity's earnings increase by more than 22% over the 3-year period. So at the end of the second year, if you notice that 20% earnings increase has not been met, then you will again enhance your estimate and say that, okay, it is likely that we will meet the requirement in the third year. So therefore, your vesting period changes, estimate changes, you will have to do the accounting as a catch-up adjustment in the subsequent period. All right, next. The fair value per share at the grant date is 122. And we always know that for ESOPs, the fair value per share at the grant date is important. There will not be any revaluation. Why? Because I do not revalue my own equity. I do not revalue my own equity. In X1, the earnings increased by 10%. All right. What is the requirement for the first year? 12%. But the earnings have increased only by 10%. So have the options vested at the end of the first year? The answer is no. And 29 employees left the organization. Why this is given to us? Because you have to be in employment also. That is a service condition. And the company has to meet the target of the earnings also. So therefore, the employees who left the organization will not be entitled to the options. That is why this is given. The company expects that the shares will vest at the end of year 2. So now you can see there is a change in estimate. There is a change in estimate. The company also expects that additional 31 employees will leave the organization in year X2. That means as on the first year end, I am estimating that a further 31 employees will leave in the subsequent year. I have to factor that when I'm calculating the cost for the first year. All right. The company also expects that additional 31 employees will leave and that 440 employees will receive their shares at the end of 20X2. At the end of X2, that means at the end of second year, the company's earnings increased by 18%. Now, what is my vesting condition? A non-market based condition saying that if at the end of second year my earnings increase by more than 20%, options will vest at the end of second year. Has it happened? It has not happened. So have the options vested? No, they have not. So the estimate further needs to be revised. So therefore the shares did not vest. Only 29 employees left the organization during X2. You thought that 31 will leave. As against that, only 29 have left. When you factored the first year's cost, you thought that 31 will leave. But now when 29 have left, that additional 2 employees who did not leave, that also will be taken as a catch-up adjustment in the expenditure for the second year. The company believes that additional 23 employees will leave in X3. So this is what the company believes. I needed to estimate the expenditure for X2. Okay. And then the earnings will further increase. That is what the company expects, so that the performance target will be achieved in 20X3. This is what the company believes. So now the vesting period has gone from 2 years to expected period of 3 years. At the end of year 20X3, only 21 employees have left. You thought 23 will leave. Now only 21 have left. So it is a combination of service plus a performance target, which is a non-market based condition. Assume that the company's earnings increased to desired level and the performance target has been met. That means at the end of the third year, the performance target has been met. The shares have now vested. So therefore, what you will do at the end of third year, the options have now vested and you have the actual data. What is the data? The performance targets being achieved, as well as the number of employees who are actually there in whom the employees have vested. Both these things you know. So you will know your expenses for the third at the end of the third period, cumulative, minus what is recognized in the first year, what is recognized in the second year, you deduct. The balance will be the expenses for the third year. Determine the expense for each year and pass appropriate journal entries. Okay. So I will tell you the amount of expenses. Journal entries will be the same. Employee benefits expense account debit to share-based payment reserve. And when they would be exercised, that time you pass share-based payment reserve account debit to equity share capital, depending on the exercise price, what is received. Okay. Ambika from Mumbai. Sir, good morning. For change in estimate, is Ind AS 8 disclosures required? Yes, Ambika, you will need that because you will be having a change in estimate. You have to tell that, see, look, this was my estimate previous year, but this has changed in this fashion in the second year. So you will have to give the disclosures of the changes in accounting estimates. All right, that will be given, that will be done as a part of the disclosures in Ind AS 102 as well, which we will be covering towards the end of the session. Okay. All right. So let us now come to the calculation part. All right, let me stop the share. Okay. So now I hope you have the presentation. It is the same one like that was there on the 9th, no change. I will, you can go through that. Okay. So let us now come to the problem. This is an earnings. This is a condition which is non-market related. So will it affect the fair value? The answer is no, it will not affect the fair value. Therefore, what you will do, it will only affect the number of shares expected to vest. So you will be factoring that in your calculation. So I am having 3 years, 20x1, 20x2, 20x3. Okay, you, 1 minute. 1 minute. 20x1, x2, x3. These are the 3 reporting periods. All right. Now, what is your total number of employees? Total employee count. The total employee count is given in the first line. 100 shares to each of its 500 employees. So at the beginning, you had 500 employees. Now, the shares will vest in only those employees who will remain throughout the vesting period. So therefore, in the first year, if you read the problem, the fair value per share is 122. I will take that. In X1, 29 employees left. So less employees left, less actual employees left. This is the count. These employees will not get the benefit of the expenditure. So therefore, this comes to 29. And at the end of the first year, you came to know that Are the performance condition target met? The answer is no. So the option will go to the second year. So you have to estimate how many employees will remain at the end of second year and accordingly determine the expenditure for the first year. So less estimated departure of employees. At the end of year 1, I expect that 31 employees will leave. So what do you expect? At the end of year 2, you expect that 500 minus 29 minus 31. You expect that 440 employees will be there. You expect that 400 employees will be there. This is your expectation, number of employees at year end. Which year end? This is second year end. Okay, don't be confused. This is second year end. Now, number of shares per employee, how much? 100 options. That is 100 shares. And what is the fair value at the grant date? Fair value at grant date is rupees 122. Fair value at grant date is 122. But wait a minute. 440 is the number of employees that will be there at the end of the second year. So I cannot just multiply 440 into 100 into 122 and say that this is my expense for the first year. No, no, no. Half of that will be expenditure at the end of first year. Why half? Because you estimate that you will meet the vesting condition at the end of the second year. Therefore, half. So what will be your proportion? Proportion here is you estimate half of the shares to vest. You estimate, sorry, proportion will be half. That is, you estimate the vesting period to be 2 years. So first year it will be 1/2. Now, expenses for 20x1. What will be the expenses? It will be 440 employees likely to be present at the end of 2 years, assuming that my vesting conditions are met at the end of 2 years, into 100 options per employee, into 122 fair value at the grant date, into 1/2, being vesting period expected 2 years. Out of that, only first year expenditure has been accounted. So therefore, you get 440 into 100 into 122 divided by 2. So that gives you an expense of 26 lakh 84,000. 26 lakh 84,000. What is this? This is the expenses that you will record for the first year, because I have taken only half. So at the end of first year, you will take your entry as employee benefits expenses account debit to share-based payment reserve 26 lakhs 84,000. Clear? And now we come to the second period. Second period, now you can think it of like this. 500 was the employees that were there at the beginning of the year. Out of 500, 29 had already left. So you can take it as 500 minus 29. So at the beginning of the year, you had 471. You had 471 employees in employment at the beginning of 20x2. Now you read the question, how many employees left? Only 29 employees left in the second year. So only 29 employees have left in the second year. And what do you expect? The target has been met at the end of second year. The answer is no. Your earnings have increased only by 18%. They should have increased by 20%. So now what do you estimate? You change your estimate. Earlier you thought it will vest at the end of second year. Did it vest? No. But it is a change in estimate. So do a prospective accounting. Now you estimate it will happen at the end of third year, the vesting. So therefore, now you increase your vesting period to 3 years. So you thought 29 employees will leave. Correct. Sorry, you thought that 31 will leave at the end of year 1, but how many left? Only 29 left. This also is a change in estimate. Thought 31 left, actual departure is only 29. This difference of 2 employees will be factored in the expense calculations for year 2 as a catch-up adjustment. At the end of year 2, options did not vest. So you think that now they will vest at the end of year 3. So how many employees expected to leave at the end of year 3? You expect that to be 23. You expect that to be 23. So therefore, 471 minus 29 minus 23, that leaves you with 419 employees in whom the options are likely to vest at the end of year 3. You could do it this way, or alternatively, what you could do is take 500 employees total count. Number of employees actually left is 58. You could do it this way also. The answer will remain the same. All right. I think the module has given 500 minus 58. You could do that also. You could do 471 minus 29 also. Number of share options per employee is 100. Fair value at the end, at the grant date, will not change. That will remain fixed. And now what do? You estimate that the vesting period has increased to 3 years. Why? Because for sure it has not vested at the end of 2 years. That I came to know. So now you expect 3 years, out of which 2 years have passed. So the proportion of expenses that you will charge is 2/3. The proportion of expenses that you will charge is 2/3. So 419 into 100 into 122 fair value per option into 2 divided by 3. So therefore you get how much? 34,07,867. This is your cumulative expense. Less recognized earlier. How much you recognized? 26,84,000. This is what you recognized earlier. So therefore, 34,07,867 minus 26,84,000. How much will you recognize now? 7,23,867. What is this? This is expense for 20x2. This is your expense for 20x2. 20x1 26,84,000, 20x2 7,23,867. But have the options vested at the end of the second year? The answer is no. I did not meet the earnings requirement. So therefore, I thought they will vest at the end of the third year. And have they vested? The last line of the problem tells us that assume that the company's targets have been met at the end of third year. So at the end of third year, your vesting conditions have been met. How many employees you have? 471 minus 29. So you have 442 employees at the beginning of the third year. Out of 442, how many employees have left? Actually, you thought 23 will leave, but actually only 21 have left. And do you need estimated departure in the next year? You do not need. Why? Because now the options have actually vested. You got the information, you met the target, the options have actually vested. So this is not required. So 442 minus 21, that leaves you with 421 employees in whom the options have actually vested. What is your number of shares? 100 shares. Fair value at the grant date is rupees 122. And proportion of expense. What is the vesting period now? It is fixed at 3 years. So now at the end of third year, all the expenses should be charged. So this will be 3/3. Entire proportion. Why? Because 3 years is your vesting period. Henceforth, there will not be any vesting period. Henceforth, it will be only exercise of options. So this is how the proportion is 3 by 3. So 421 employees into 100 into 122. Your total expenditure should have been 51,36,200. 51,36,200. Out of that, how much is met at the end of year 2? You have recognized 34,07,867. So how much will you recognize as expense for the third year? 51,36,200 minus 34,07,867. So your expense 17,28,333. This will be expense for 20x3, and you will be passing the entry as 26,84,000 first year, 723,867 second year, 17,28,333 for the third year. Okay. Ambika from Mumbai. Sir, if condition is met in the second year, then the expenses will be 442 into 100 options. The entry will be, 471. 1 second. Minus 29, 442 employees into 100 options per employee, fair value at the grant date 122, that is right, multiplied by 2 by 2. Okay, so you are thinking that it was correct, so into 2 by 2 minus 26,84,000, absolutely right. So that would be the entry, that would be the amount that would be passed for the journey for the second year. All right, so your understanding is right, and this is how you will do the accounting. This is how you will proceed to do the accounting. Now you will pass entries: employee benefit expense account debit to SBP reserve 26,84,000 year 1, employee benefit expenses account debit to SBP reserve 723,867. Employee benefit expenses account debit to SBP reserve 17,28,833 means in effect you have charged an expense of 51,36,200 over a period of 3 years. Over a period of 3 years. And you are now having SBP reserve credit balance of 51,36,200. So what will you do with that credit balance? When the options get exercised, you will write SBP reserve account debit to equity share capital 51,36,200. It depends what is your exercise price. That becomes accounting in the exercise period, which we have already seen. All right. So this was the first question that we had for today. Let us proceed to the next one. Okay, let us proceed to the next. I hope you have noted down everything. Yes. Okay. Next question. Let us proceed. Yeah. This is illustration 8, again taken from your study module. ACC Limited granted 10,000 share options to one of its managers. So only one employee is there who is getting the options, 10,000 options. In order to get the options, the manager has to work for the next 3 years. So 3 years is now your service condition, number 1, and reduce the cost of production by 10%. So this is a performance condition. So as I said, performance condition will always be service condition plus a target. Fair value of the option at the grant date was 95 rupees. All right, that is also given to you. That you will take to measure the expenses. Cost reduction achieved at the end of year 1, 12%. So you have achieved, you expect that it will be achieved over the next 2 years also. At the end of year 2, cost reduction achieved is 8%. Therefore, what you think? You think that the options are not expected to vest in the future. This is interesting. All right. When we do year 2 expenses, we will come to know. At the end of year 3, 10% is the cost reduction achieved. And if you look at the average over the 3-year period, 12% first year, 8% second year, 10% third year, 30 divided by 3, 10% per annum, you have achieved a reduction in cost of production. So these options have actually been met. These options have actually been achieved. They have vested at the end of third year. So the question is how these expenses would be recorded. All right, we'll be doing that. Just a minute. Ambika once again. Sir, what if the condition is not met in the third year? The option lapses, correct? If conditions are not met at the end of third year, the option will lapse. If it lapses, then will be transferred to retained earnings. Yes, the SBP reserve balance will be transferred to your retained earnings. The SBP balance will be transferred to your retained earnings. Okay, so now let us come to illustration 8. We will look at the calculation. It is particularly interesting. All right. The reason being, we'll come to see in just a while. Cost reduction is a non-market based performance condition. So therefore, it will affect the options likely to vest. It will not affect the fair value of the options. All right. So I am having 3 years. Year 1, year 2, year 3. 3 years in all. Number of options is how much? Only one employee is there. He is getting 10,000 options. He is getting 10,000 options. The fair value of the option, is 95. The fair value of the option is 95. I have to do all the 3 years. Very simple reason. He has to remain in employment for 3 years. That is also a condition that is put on him. So therefore, I have to distribute the calculations over 3 years. Whereas in the preceding one, you had to remain in employment as long as the performance target was achieved. So if it was achieved in the first year, then that's it. You are entitled to the options. Here, that is not the case. Here, it is vesting condition being a service condition already imposed plus a performance target at the end of 3 years. So both the things are there. In the previous one, service condition was implicit. Service condition was implicit. It was understood that the year in which they are meeting the performance condition, they should be in employment. That is understood. In the second question, the service condition is explicit. They want you to be there for 3 years and meet the cost reduction target. All right. So fair value 95 for the options. And then what is the proportion? Now, first year you achieved a reduction of how much? 12%. So now you thought, all right, first year I achieved 12%. I am on track to achieving the balance cost reduction target over the balance period of 3 years. I can do that. So therefore, 1/3. Therefore, 1/3. So 10,000 into 95 into 1/3. Your expenditure for the year will be 10,000 into 95 divided by 3. 3,16,667. But what is happening in the second year? And Uma has raised a question in this regard from AP where she says, why don't we consider these options will vest at the second year as the cost reduction is only 8%? Why are we taking the average? Or I think it should be, why are we not taking the average? The answer to that is, look at the question. The question is saying, the cost of production is reduced over a 3-year period, not over a 2-year period. In fact, the question that Uma has asked is very, very relevant when you are auditing this estimate. You can now see the impact of this estimate. That is why I said it is a very interesting question. In the second year, you achieved a cost reduction of 8%. And now you are estimating that I will never meet this cost reduction. That means at the end of third year, my cost reduction target of 10% will not be met. That means what you are estimating sitting today on the second year, you are estimating that these options will not vest at all. Why? Because you are estimating that 10% reduction will never happen. That you are estimating in the second year. So when you estimate that, your vesting will not happen at all. So therefore, the proportion will be 0. You had recognized 3,16,000, but now you thought that options will not vest. So I do not have to pay anything to them. It will be 0 for the entire period minus what you recognized earlier. 3,16,667. You will have a reversal. You will have a reversal. Minus 3,16,667 is the reversal that you have. And this is something that is very questionable when you are auditing this estimate. This is something that is very questionable, because if this is the scenario, then anybody can do an earnings management technique. How? First year, suppose profits are good. They will say, all right, we thought that the options will vest at the end of 3 years. So we estimate a 1/3, 3,16,667. Suppose in the second year, they come to a thought process that the options will not vest. Although the conditions appear to vest, 12% first year, 8% second year, average of 10% per year is met even in the second year. So you have to be very critical when you are evaluating this change in estimate. When the management says it is not likely to vest, you have to evaluate it. You will have to check for post balance sheet events. You will have to check what is the cost reduction that is achieved up to the date of signing the audit report. That is an aspect of audit wherein SA 540 tells auditing accounting estimates, as well as the auditing standard on subsequent events. I think SA 560. You have to be very critical when you are evaluating this change in estimate, because it is a classic earnings management technique. Whenever there is an estimate, what do? You pass a JV. There is no cash inflow, cash outflow, but what is being impacted is your earnings. First case, you had sufficient profits. So you thought, all right, let me show this expense. So expenses account debit to SBP reserve. Second year, the cost reduction giving me an average of 10%. Yes, the condition is what? 10% average over 3 years. I am achieving 10% over 2 years. So therefore, there could be a possibility that I could achieve the target over 3 years. So therefore, you have to be very critical when you are evaluating this change in estimate. You will have to be very critical when you are evaluating this change in estimate. All right, at the end of the third year, now look at the impact. What is happening at the end of the third year? At the end of the third year, that manager has achieved 10% more cost reduction. So he achieved 10%. So now what is happening? 10% is your average per year. 10% is your average per year. And are the options vested now? And the answer is yes, they have vested. So now the proportion will be entire. The proportion will be entire. That is 3/3. You have met the requirement. So therefore, 95 into 10,000, 9,50,000. Previously recorded expenses was how much? 3,16,000 first year. You reverse that. So previously recognized expense is 0. So you are taking this entire hit in your third year's profit and loss. You are taking the entire hit in your third year's profit and loss. Therefore, my friends, whenever you are going to look at changes in any estimate, tomorrow you may study some other standards where there will be a change in estimates. See, when you come to your level, that is at final CA level, the focus has now radically shifted from just achieving tallied balance sheets to looking at the impact on the true and fair view of your balance sheets. How true is my, and as you all know that my financial statements rely on estimates to a great extent. The management estimates to a great extent. The management tells you we estimate this, and at your stage, when you come to the profession, you will have to be critical for every estimate that the management makes. All right, be absolutely critical to avoid this kind of a scenario. To avoid this kind. So Uma's question, why don't we consider these options will vest at the end of the second year? Okay. But sir, if we had achieved the average 10% by 2 years, why did we allow to nullify the expense in year 2? This is from Kalyani from Thane. Okay. Simple. Read the problem. Let me share the problem once again. See, look at the problem. In order to get the options, the manager has to work for next 3 years, number one, and reduce the cost of production over the next 2 years, over the next 3 years. I'm sorry. He has to be in service for 3 years, meet the cost reduction over 3 years. So what you are having the confusion is what exactly I am mirroring to you. All right. Now pay attention once again. This is your timeline. Year 1, year 2, and year 3. All right. Now you have to get an average cost reduction of 10% over 3 years. You have to get an average cost reduction of 10%. First year, I got 12%. What I think now as the management, I will achieve this target at the end of year 3. Therefore, 1 by 3 expense is charged. In year 2, I got 8%. So what the management is saying, second year it has become 8%. That means third year, it may remain below 10% only. See, anything below 10%, for example, if it comes to 9%, have I met this requirement of 10% average? The answer is no. 12 plus 8, 20 plus 9, 29 divided by 3 is not 10%. So the management is estimating that in the next year, I will not achieve the reduction of 10%. So what the management is now thinking, the management is thinking in the year 3, I will not achieve the reduction. The management is becoming so foresighted that it is now thinking the options will not vest at all. The options will not vest at all, because remember, this is not only a service condition. This is also a performance condition. You will have to revise your performance condition year on year. You will have to revise your estimate of the performance condition year on year. So here at the end of year 2, I estimate that 10% per annum, this condition will not be met. So therefore, the management is estimating that these options will not vest at the end of year 3. Therefore, in year 2, I nullify the expenses of year 1. And I say, I don't have anything to pay. But you are in for a surprise in the third year, or rather, I would say a shock, when at the end of the third year, you notice that 10% cost reduction has been achieved, bringing the average cost reduction to 10% per annum. What are you doing in effect? Expenses for second year, you are actually shifting it to the third year. You are actually shifting it to the third year by virtue of what could possibly be a misplaced estimate. What could possibly be a misplaced estimate? So this comes into the realm of critical audit perspective. All right, you will have to take a critical view of this estimate. I am perfectly on your side, Uma. I am perfectly on your side, Kalyani, when you think, how can this happen? All right, now, Uma is asking, sir, my question is, why are we considering average? If we don't consider average, we may think the options will lapse. As the word average is not there in the question, how do we know whether we have to take average? Okay, now see. Share. Okay. Look at that. Reduce the cost of production by 10% over the next 3 years. It is the term 10% over 3 years means what? It does imply that you have to take the average. That is, what do you mean? 10% cost reduction over a period of 3 years automatically means that it must be an average of 10% per year. That is what is your requirement. That 10% need not necessarily be 10% in each year. It can be 1 year high cost reduction, another year lower cost reduction, a third year you could have something like 10% here, thereby getting your average cost reduction of 10% per annum. So I hope I have satisfied Kalyani. Thank you. Kaustubh, thank you. And Uma, I hope your your question is understood. 10% over 3 years. That very statement tells us that we will have to take it on an average basis. We will have to take it on an average basis. Is it okay? It is not 10% per annum. Be careful. The word used is not 10% per annum, but 10% over a 3-year period. So that is the cost reduction which you are working for. Okay. So please be critical. All right. This is part of your audit outside my domain for the academic purposes, but please be critical when you are evaluating accounting estimates. All right. Because this is where management generally does what you can say earnings management techniques. It could be intentional also. It could be intentional also to inflate the profitability, Take the best example, the period through which we are going through. This COVID has rendered your all the calculations, what you can say, it has put all your calculations, all your estimates to waste. So what the management will do? It may employ creative accounting techniques. These are all creative accounting techniques. Take an estimate, reverse the estimate. Make a provision, reverse the provision. That is why we are having Ind AS. Ind AS 37 provisions tells us under what circumstances provisions should be made to avoid reversal of provisions. Likewise, you're having the estimates, and we have coupled with SA 540 on auditing accounting estimates. Yes, so be absolutely critical. Look for information that is reinforcing your skepticism. Look for information that is reinforcing your skepticism and not the management's point of view. All right. So with this, let us proceed to the next question. All right. Okay, question number 7. I leave this for homework. I leave this for homework because it is something in the test your knowledge. Concepts are exactly the same. Only thing is you are given the third point. Employees expected for vesting rights by the first year is 97%. It revises to 95%. This is the total number of options likely to vest at the end of the vesting period. This is given to you to be 97%. That comes to 95%. That comes to 93%. So this is similar to what we have done in the first question. I want to cover more and more questions, more and more topics. So therefore, please do this for homework. Please do this for homework. I will be sharing the complete calculation sheet with you at the end of today's session. So you can go through that for better understanding. Okay. Uma, I hope you are convinced. Okay. Uma, I hope you are convinced. Please drop in a message if you are convinced or if you still have any doubts. Okay. If you have any doubts, I will be happy to explain it. Okay. May not be right now because we have a lot to cover, but I will possibly, reach out to you by an email to explain your query. Okay. But please write whether you've understood or not. So I leave question number 7 for homework. Let us come to the next question. That is, compute the expense to be recognized in the following case. Share options granted 25,000 share options. Vesting conditions, the vesting occurs if product X's market share exceeds 25% at the end of 4 years. So 25% increase in market share should happen at the end of 4 years. Estimated and actual forfeiture rate is 8% in 4 years. Probability assessment at the grant date. What do you think? At the grant date, when you granted the shares, the condition is deemed not to be probable based on current projections. That means what? You are today thinking this option will not vest at all, similar to what we did in the previous problem. Today itself, when you granted the options, you thought these options will never vest. The condition is deemed not to be probable. Grant date fair value is 8 rupees per share option. There is a change in the probability assessment now. During year 3, product X's market share is projected to be 30% at the end of 4 years. It is projected to be 30%. That means when you gave the shares, you thought they will not vest. So what you would have done? You would have recorded 0 expense. Year 2, there is no change in what you expected. So again, it will be 0 expense. Now, year 3, you are thinking that you got extra evidence now. 30% market share has increased. So now what you will do, you will revise your estimate. And then you will now say at the end of 4 years, it is likely to be achieved. It is likely to be achieved. So therefore, you will now record the expenses. You will now record the expenses, and accordingly, year 1 expense not accounted. Year 2 expense not accounted. Year 3 expense, you will not only record only for year 3, but what you thought would not estimate has now happened. So your year 3 expense will be a cumulative expense of the first 3 years. Will be a cumulative expense of the first 3 years. All right. So this is the problem with estimates. You cannot just, go on estimating because new facts come to light. You will have to be critical as an auditor. All right. So let us solve this question. This will not take much time. All right. I hope you have the questions in front of you. All right. Now, number of options expected to vest. How much is that? 25,000 options, but you thought 8% will not vest. So how much will vest? 92%. So 25,000 into 92%. So that gives you how much? 23,000 options. That gives you 23,000 options. Now, total estimated compensation over 4 years. Total estimated compensation over 4 years. What is it? That is nothing but 23,000 options, and each option has a fair value of rupees 8. So 23,000 into 8, that gives you how much? 1,84,000 rupees. Now you have to allocate these expenses of 1,84,000 over a period of 4 years. But wait a minute, read the problem. You are thinking that in year 1 and year 2, what do you think? The condition is deemed not to be probable. So now compensation cost per annum is how much? Rupees 84,000 divided by 4 years. So 1,84,000 divided by 4. Per year, you should be charging 46,000. Should be. I'm using the word should be. Of course, it depends on your estimate. Now, you think that at the end of when you granted the shares, you think they will not vest. Second year, you think they will not vest. So compensation cost for years 1 and 2. What did you think? Will they vest? You think they will not vest. So will you debit any compensation expenses? You will not. So compensation expenses for the first 2 years is 0. Now for year 3, compensation cost for year 3. For year 3, suddenly you wake up and see Array, I achieved 30% increase in market share. So therefore, what you will do? Now you are thinking they are likely to vest. So therefore, it will be 46,000 into how much? Not just for year 3. You will now take the cost for year 1 also, year 2 also, year 3 also. One thing is clear, this will not be taken as an error. Why? Because this will be treated as a change in estimate. So the management is protected by that fact. The management is protected by that fact when it says, we thought we will not achieve this target. So they will say, it cannot be a prior period item. It cannot be an error. You have studied in AS 8 what is an error. Change in estimate is not an error. So this 46,000, I will give only a prospective effect. I will give only a prospective effect. So I will record all the 3 years expenses now. So 46,000 into 3, you have to take a hit of 1,38,000. You have to take a hit of 1,38,000 in the third year. And assuming that the conditions continue and 92% actually vest and you meet the requirement, compensation cost for year 4 will be 46,000 into 1, that is rupees 46,000. So this is how you will do. This is how you will do. Assuming target is achieved. Assuming target is achieved. All right. Do you see how management can play with the figures? Yes. First 2 years, my profitability may be less. So we may think, why do I need to charge? Only reason is because this is just a journal entry. So whenever you check only journal entries, please be very critical about that. All right. Because your estimates definitely cannot go so haywire. Okay. At least in year 1, okay, you think they may not vest, but at least in year 2, when you are finalizing the accounts, they would be finalized after the reporting period, right? So in year 3, when you are finalizing the accounts for year 2, you would definitely have certain estimate of what would be the market share. So the management should have thought that the expenses will be vesting. The options will be vesting at the end of year 4. They should have recorded, which they did not do. As a result, you are taking a hit of 1,38,000 in the third year. So this is how you will solve this. It is the same way of doing. Okay, 1,84,000 is 0 for the first 2 years. 1,84,000 into 3 by 4. You can do it like that also, because we are used to doing 1/3, 2/3, 3/3. Okay, so if you take that, it will be 184,000 into 3 by 4 minus what was recognized earlier was 0. So therefore, 1,38,000 will be recognized. And in the fourth year, it will be 1,84,000 minus 1,38,000. So you will recognize 46. Of course, the fourth year expense is assuming that the target is achieved. So this is how you will be doing your recording for performance condition, which is not a market condition, which is not a market condition. Okay, I hope you have understood how we do it. Treat it as a change in estimate. Treat it as a change in estimate and do the accounting accordingly. This will affect the number of options that are likely to vest. That is what it is happening. Is the fair value changing? No. What is changing? The number of options likely to vest is changing. You can check in the first problem that we did, the number of options for the first year likely to vest was 440 into 100. Then in year 2, the number of options likely to vest was 419 into 100. And in year 3, the actual vesting was 421 into 100. So when you read your text, you will come to know that the number of options likely to vest will change. All right. Okay. Now, Kalyani is asking, sir, does forfeiture means employee attrition? Yes, normally. Okay. forfeiture means employee attrition, but it is not restricted to that. Okay, but normally you can take for your academic purposes, yes, it means employee attrition. All right, they are forfeiting their claims to the options. Okay, lapsing means what? Options have vested, but they are not exercising. Options have vested, but they are not exercising. That would be lapse. Forfeiture means what? They are not fulfilling the conditions. Forfeiture means they are not fulfilling the conditions. That could be either attrition, or it could also mean you are not meeting the performance targets. Like in the case of the manager's problem that we saw, the manager does not meet the cost reduction, for example. That is amounting to a forfeiture and a subsequent lapse. All right, that is amounting to a forfeiture and a subsequent lapse. All right, anyways, so this is done. Let us now proceed to the next concept. The next concept is simple. You don't have to do all this headache. The next concept is performance condition being a market-based condition. That means what? You will tell your employees these options will vest in you if the market price reaches a particular level. If the market price reaches a particular level. So therefore, how will you do this accounting? Now, the change in the market prices will already be factored when you calculate the fair value. All the volatility, the movement in the share prices, that is all factored when you compute the fair value. So the fair value becomes a gospel truth for you when you are taking your market conditions. No, even if the market conditions are not met, be careful of what I'm saying now. Even if the market conditions are not met, the options will still vest. Why? Because the probability of the market price not being met is already factored in the fair value. The probability of the market price not being met is already factored in the share value. The probability of the market price being met, that is also factored. How much your share is volatile, that is also factored. What are the options likely to be exercised? That is also factored depending on your exercise price. So your exercise price also is factored. So therefore, all these things are included in your fair value estimate. So once you have that fair value, the market-based condition problems have to be solved just based on the fair value. The remaining conditions will be treated just as a service condition. Okay, so therefore market-based conditions with a requirement to remain in service, take the fair value, attribute it over the service period. That's it. You don't have to do anything. Why? Because the fair value has taken care of that. And in your exams, you will always be given the fair value. So therefore, you will have to take that fair value. Don't do anything. It is very simple. All right. So now, let us come to the next problem. Again, a study material problem, but a small one. Okay. Apple Limited has granted 10,000 share options to one of its directors, for which he must work for the next 3 years. And the price of the share should increase by 20% over the next 3 years. So what is this condition? One is work for 3 years. That is a service condition. You know how to attribute. Okay, 1/3, 1/3, 1/3. All right. The price of the share should increase by 20%. This is which condition? This is a market-based performance condition. This is a market-based performance condition. This condition has been factored when I determine the fair value. The share price has moved as per below details. Year 1, 22%, year 2, 19%, year 3, 25%. At the grant date, the fair value of the option was 120. Sir, 120 when I calculated, you have already factored all your volatility. Even if there is no movement in the share price, hypothetical scenario, this will never happen in real life, but even if there is no movement in the share value, the time of giving the options, grant date, share price, and the time when they are vesting, the price remains the same, hypothetical scenario, that is also factored in the fair value. So even though the price has not moved, you will ignore the effect because that is considered in the fair value. They have already considered. You are not ignoring it technically. You are factoring it in the fair value. So what you will do, you will only take the service condition and attribute the cost over the service period. Attribute the cost over the service period. All right. So market-based condition, fair value takes care of. You will be studying your Black and Scholes model, the binomial model of option pricing. So there you will actually get to see that these fair values, how they are calculated. How is an option valued? You will actually come to know when you do the option pricing model. I think you will be doing it in your SFM paper. Not sure what you are covering right now, but if you have covered, good enough. If you have not, you will be doing that. Okay, option pricing models. So there you will see volatility, prices, everything are factored. Therefore, we will not consider that. We only have to account using the fair value over the service period. Over the service period. So in this scenario, what you will do? 10,000 share options to one of its directors, the fair value of the option was 120. So therefore, 10,000 options into 120. So that gives you how much? 12 lakhs is your expense over a period of how many years? Over a period of 3 years. So per year expense will be how much? Per year expense will be 4 lakh rupees. Per year expense will be 4 lakh rupees. That's it. You don't have to bother whether I met the market condition or not. You don't have, because who has taken that trouble for you? That trouble has already been taken for you when the fair value has been calculated. So this is a simple problem. You don't have to worry much. All right, next. Let us come to the next question. This is again a test your knowledge question. You should be able to do this. I will explain the concept. All right. An entity P issues a share-based payment plan to its employees based on the below details. The number of employees is 100. The fair value at the grant date is 25. The market condition is what? That the share price should reach 30 rupees. The service condition, now here you have to be careful. The service condition is to remain in service until the market condition is fulfilled. In the previous problem, the service condition was fixed 3 years. Here it is dependent on the market condition. The moment you meet the market condition, your service condition is fulfilled. So suppose your market condition is fulfilled at the end of 3 years. It is fulfilled at the end of 3 years. Your service condition is fulfilled at the end of 3 years. Your service condition is fulfilled at the end of 3 years. Define the expenses related to such a share-based payment plan in each year, subject to the below scenarios. If the market condition is fulfilled in year 3 or the market condition is fulfilled in year 5. What is your expected completion of the market condition? The expected completion is 4 years. In the first question, first scenario, market condition is fulfilled in 3 years. So what you will have to do, you will now have to change the service period from expected 4 years to 3 years. Why? Because the implicit service condition is to remain in service until the market condition is fulfilled. Until the market condition is fulfilled. All right. So now, how do I do this problem? A very simple problem. You don't have to do many calculations. 1 share per option, will keep that as simple. They've not mentioned how many options. So now let us just do this. It won't take much time. Now, 100 employees into 1 option. No information is given. So I am calculating it on a per share basis. All right. Multiplied by what is your fair value? Rupees 25. So your total compensation cost is 2,500 over how many years? Over 4 years. This 4 years, my friends, is expected. This 4 years, my friend, is expected. What is your service period, service condition? To remain in employment till the market condition is fulfilled. So now case 1, market condition is fulfilled in the 3rd year itself. So year 1, what do you think? You estimate that I have 4 years time. You estimate that I have 4 years time. So 2,400 total compensation into 1 by 4, you will charge 625 rupees as employees compensation expense. Year 2, you again think 4 years time. So this will be rupees 625. Year 3, sir, I have met the market condition in year 3 and my service condition depends on when the market condition is fulfilled. So now my service condition is fulfilled in the 3rd year itself. So therefore, your total compensation expenses will now be changed into 2,500 into 3 by 3. So this will be 2,500. Out of that, you have already recognized how much? 625 plus 625. That is 1,250. So your expense for the 3rd year will be 1,250. Year 4, you will not recognize anything. Why? Because the options have vested. The performance condition has been met. The 4-year period is your expectation. Can your expectations change? Very much. So therefore, reality and expectations will always be different. So therefore, you will not allocate anything to year 4. Why? Because the market condition is fulfilled in the 3rd year itself. Let us come to the second scenario wherein they are telling the market condition is fulfilled not in the 4th year, but in the 5th year. So year 1, you will charge 625. Year 2, also you will charge 625. Year 3, 625. Year 4 also you will charge 625. But have the options vested? No. Why? Because the share price is not met. Year 5, you will not charge anything. You will not charge anything. Why? Because your expected period of 4 years has been factored when you have calculated the fair value. So therefore, you will not treat this as a change in the vesting period, but over 4 years only you will meet the requirement. Over 4 years only you will meet the requirement. Suppose I do not get that price at all. Year 5, it has never been met. Then also you will allocate these expenses over 4 years. Why? Because that 4-year period has already been factored when I'm calculating the fair value. All right. So this is done. Let us now proceed to the next question. An interesting one that deals with an FAQ that is issued by the institute on COVID-19. Okay. So this is a set of FAQs that the institute has issued, and these FAQs have considered the COVID impact and how they should be treated, how the Ind AS should be given effect to in light of the COVID-19 impact. So read the problem. An entity has a number of equity settled share-based payment schemes for its employees across different categories. During the last financial year, that is 2018-19, the entity had granted equity shares to the senior management, which will vest on 30th April 2021. All right. And one of the conditions for final eligibility of equity shares is based on the target market price of the entity's share by the end of the financial year 2021. That is 31st March 2021. Considering the current scenario affected by the global pandemic, the entity expects to experience a severe depressed economic environment in its business sector and substantial decline in its financial performance and cash flows over the next 2 years, and therefore a consequential decline in the market price of its equity shares. As of 31st March 2020, the share price of the entity's equity share is much below the target price required under the employee's share-based payment scheme. How should the entity consider this development in the accounting for its equity settled share-based payments for the current financial year 2019-20 is the question. All right. So now the market price will not be met on 31st March 2020. Why? COVID-19 pandemic hai, and as a result, you will be having depressed performance. Let us assume this is a travel company. All your travel companies have almost gone into hibernation mode, all right, because of the COVID-19 pandemic. Now you are seeing resumption of hotels and holidays and flights, although it is not to the fullest extent possible. But because of this depressed environment, the price has gone down. And it has gone down to such levels that resurrection of the prices by 31st March 21 was never possible. So technically, you are not meeting that market condition. But will you have to consider any effect of that? The answer is no, sir. You do not have. Why? Because it is factored in your fair value. Because the possibility of not meeting is factored in your face value. So in your fair value, But you may ask a question, sir, COVID-19 cannot be factored. COVID-19 cannot be factored because it is a very, very unexpected event. Sir, when did you give the options in 2018-19? In 2018-19, when I gave the options and I determined the fair value, I never thought even in the wildest of my dreams that that something like COVID-19 will happen, because air travel always showed a growth. Hotels always showed an increase in occupancy. We were a cash-rich company. You could be doing that. So you could be having this in your mind when you say, sir, 18-19, when I gave the options, I did not think something like COVID scenario could ever arise. Then how can you say the fair value is factoring? The fair value does factor, although a COVID-19 scenario may not be factored, but the fair value does factor the probability of the market price not being met. If truly your option prices have gone for a toss, if truly your share prices have gone for so much of a toss that your fair value has become meaningless, then what the company can do is it can modify the option. The company can modify the option. If it depends on an exercise price, the company can reduce the exercise price. Why? Because my market price has gone down. The company may reduce your exercise price, thereby impacting the fair value, thereby modifying the plan. But if none of this is done, then please remember that this answer to this question is that nothing is to be done. The things have been factored into the fair value calculation. This is just a trick question for you. However, if your options are based on non-performance conditions, like achieving a certain profitability, then at that point of time, you will have to take a call. You cannot say that profitability, when I decided, I had factored the probability of not meeting the profitability. Yes, that would be a very, very far-sighted assumption to make. So the answer to this question, no effect is to be given in the fair value unless there is a modification in the plan. Otherwise, it will continue as it is. Irrespective of whether the market conditions are met or not, as long as my other conditions are met, the options will vest. Why? Because fair value takes care of it. My fair value cannot, sir. This is a one-off event that I never factored. Likely scenario, but yes, true. If you had factored it, probably your fair value would be something different. If you had factored your fair value may be something different, then in that scenario, what you would do, if the management is truly worried about this, then the management will go ahead for what? It will go ahead for a modification of the plan. So now we discuss the next aspect, that is modification of your plans. We shall now discuss the next aspect, that is modifications to the plan. What do you mean by modifications? Modifications means any changes that have happened to your equity settled share-based payment plans. Can modifications happen? Yes. Depending on new circumstances coming into light, you can do a modification. Modifications can be of two types. Modifications beneficial to the employees, modifications not beneficial to the employees but beneficial to the company. Sir, give me an example. Suppose your service condition is 4 years when you first gave the option, and 1 year down the line you say, no, my service condition will not be 4 years, it will be 3 years only. Is this modification beneficial to the employees? The answer is yes. Those employees who would be leaving in the 4th year, as long as they are in the 3rd year, they will get the options. So this is a modification that is beneficial to the employees. Reduction in exercise price. Is this beneficial to the employees? Yes, it is beneficial to the employees. Because of reduction in exercise price, it will have an impact on the fair value. So the change in the fair value due to a reduction in the share price beneficial to the employees will have to be accounted for as a modification. Will have to be accounted for as a modification. First point. Second point, sir, can you give me an example of modification not beneficial to the employees? Simple, take the opposites of these two. Suppose in the original plan, the shares will vest at the end of 3 years. And then you wake up and say at the end of the first year into the plan, you say, no, shares will vest at the end of 5 years. That means an employee who was to work for 3 years will now have to work for 5 years. He will say, Isme, what is my benefit? There is no benefit that accrues to me. Or exercise price has increased. As a result, the fair value of my option has changed. So therefore, increase in exercise price, will it be beneficial to the employees? No, they will have to pay more for that. They only see that. They will not see what is my fair value and all. That all they don't know. They will just see you increase the exercise price. This is not beneficial to me. So what does the standard tell us? How do I account for modifications? Two things. First is what should I account? Second is how should I account? So let us first answer the what, then we shall come to the how. What means I have two options. Options beneficial to employees, that means resulting in a cost to the company. Options not beneficial to the employees, beneficial to the company, resulting in a reduction in cost. The standard tells you will record only the effect of those modifications which will be beneficial to the employees. In other words, modifications which are not beneficial to the employees, modifications which are resulting in a reversal of your costs, modifications resulting into a reversal of your cost, you will ignore. Modifications resulting into reversal or reduction of your cost, what you will do? You will ignore, and you will only consider those modifications which are in effect beneficial to the employees. And when will modifications be beneficial to the employees? When it increases the employee benefit expenses of the company. Fair enough? Is it clear? So you will have to look into the problem to check whether this modification is beneficial or not beneficial. Number one. Sir, how do I account? Now you know what you have to account. Now let us discuss how you have to account. Now you are having the original plan. Just I'm giving an example. All right. We will see the problems that are going to happen. Original plan, you had year 1, 2, 3, 4. When you issued the shares, you have given them a vesting period of 4 years. But at the end of year 1, you tell them Vesting period is only 3 years. So prospective. Earlier, how you used to apportion the expenses? 1/4, 1/4, 1/4, 1/4. Now, how you will account for the modification? First year, you have to do 1/4 because modification is happening at the end of the first year. In the second year, now new things have come into light, which is my vesting period is 3 years. So now it will be 2/3 and 3/3. So 2/3 total expense minus what you have recognized earlier, 3/3 total expense for the 3 years minus what you have recognized in the preceding 2 years is how you will do the accounting. This is accounting for a change in your what you say vesting period. There is one more term that is used for this. It is known as accelerated vesting. What is it? Accelerated vesting. Naturally, na acceleration. This is acceleration only. What used to take 4 years to vest, it is now taking only 3 years. That means you have accelerated. So you will account for accelerations like this. Suppose there is a change in the fair value such that the fair value has increased. You may have decreased the exercise price or prices may have increased such that the fair value of the option has increased and you are modifying the plan. What are you doing? You are modifying the plan and putting that new fair value into the plan. You are modifying the plan, increasing the fair value. Is increasing the fair value beneficial to the employee? Yes. For me, it is a cost. For them, it will be a benefit. Why? Because they are getting shares having more value than before. So now let us take the second scenario. Okay. Same. Year 1, year 2, year 3, year 4. Let us assume that the fair value when I gave the option was 100. The fair value when I gave the option was 100. So what you would do, how would you attribute? Suppose this 100 is given for one employee, one option. So your total compensation expenses is 100. So what you will do now? 4 rupees, 1/4 each year. So 25, 25, 25, 25 was the original plan. This was the original plan. Now you modify the option. You modify the option such that at the end of 2 years, you will now tell the fair value of the option is now 130. Is this beneficial to the employees? Yes. Maybe you are giving a share whose prices have increased tremendously because of your operations, because of your disruptive technologies. Maybe you are making such bumper profits, or you have just reduced the exercise price considerably because you want employees to exercise the shares. The employees came to you in year 2 and said, sir, you have given me a high exercise price of say 500 rupees. This much we cannot afford. So the management will say, all right, if that is the scenario, I am giving you the shares because I want you to be motivated. I want you to be motivated. So I will reduce the exercise price from 500 to 200. Now, this is a big motivation. Those employees who thought they cannot invest, they will now invest. So now the fair value of the option has gone from 100 to 130. That means what? There is an incremental fair value of 30 rupees. There is an incremental fair value of 30 rupees. When is this incremental fair value happening? After year 2. So what the standard tells, original plan do not change. Original plan do not change. Rather, this modification, that is the incremental fair value, you will apportion this over the remaining vesting period. So remaining vesting period is years 3 and 4. So you will charge 15 here, such that at the end of the vesting period, 100 plus 30, 130. Why is this happening? Again, the same reason. This is a change in estimate, and all the changes in estimate have to be given a prospective effect. You cannot say that 130, then we will do 130 divided by 4, 32.5, 32.5, 32.5, 32.5, and we will take this as a prior period item. Aap nahi kar sakte. You cannot do it like that. This is not permitted. Rather, you calculate the incremental fair value and you apportion that incremental fair value over the balance vesting period, all right. This is how you will have to account for your modifications. I have discussed modifications in the period such that the vesting period has reduced, and I have also discussed modifications to the fair value. And the fair value modifications calculate the incremental fair value. Which fair value? Calculate incremental fair value and allocate the cost over the remaining vesting period. The original plan continues to be accounted as it is. The original plan continues to be accounted as it is. And finally, don't forget, modifications not beneficial to the employees will be ignored. Sir, why they will be ignored? Because they could be again viewed as an earnings management technique. They could be again viewed as an earnings management technique. You can say, I give an option to vest in 3 years, then 5 years. What are you doing? You are essentially from 1/3, 1/3, 1/3, you are going to 1/5, 1/5, 1/5, 1/5, 1/5. In a nutshell, your expenses per year are going to be reduced. Yes or no? So therefore, the standard will tell, please don't do all this. Record only those items which are beneficial to the employees, not beneficial to the employees. Please ignore. Not beneficial to the employees. Please ignore. So you will be, you could be getting questions relating to modification. So whenever you see the modifications, what you have to check whether it is beneficial or not. If it is not beneficial, do you have to account for it? No. You account for as per the previous plan that was in force. That's it. There is no other change. All right. So with this background, let us come to the next question. All right. Let us come to the next question. All right. I hope the speed is fine, everyone. Yes, I hope you are clear, the concepts you are following, the reasoning you are following behind the concepts. Yes, I am more worried about that, because problem solving and all we are able to do, but I will appreciate if one of you just sends that, sir, the pace is fine. All right. And let us now complete come to the next set of questions. We still have a lot to do. All right. Modifications to an equity settled share based payment. Okay. What I will do is, this is this question, I will do a better question that will cover these concepts as well. I will do a better question that will cover these concepts, because this is there in your study module. You can this. Okay, I am doing all your problems what the institute only has given. I have taken it either from what you can say, I have taken it either from RTPs or from past papers, to the extent they are not covered in the study module. So this question, you please do it later on. You please do it later on. I am doing a better question for you. I am doing a better question for you. So that question, when you do, you will be able to appreciate it better. Okay. 1 minute. Let me see which question. Slide 18. And then 100. Okay. Let us come to this question. It is a similar one. It is a similar one. So therefore, this, okay, Kaustubh, thank you. It is fine. Ambika, Neha, and Kalyani, thank you so much. So we'll now proceed. This is from your old syllabus. Principles are the same. We will do the accounting accordingly. All right. Now, the following particulars in respect of stock options granted by a company are available. Number of employees covered is 600. Options per employee is 60. Vesting conditions, continuous employment for 3 years. That is your requirement. So spread your expenditure over 3 years. Nominal value per share is ₹100. Vesting period is 3 years. Exercise period is 1 year. Fair value of options per share on the grant date is ₹14. Exercise price per is ₹125. Now, Position as at the end of year 1. Number of employees that have left is 30. Estimate of number of employees to leave is 70. Exercise price was reduced to 120. Fair value of original option is now 13. Fair value has now come down by virtue of reduction in your exercise price. Fair value of option at reduced exercise price is 15. The the fair value of your original option from 14 came down to 13. You want to encourage your employees to buy the shares, so you reduced the exercise price. As a virtue of that reduction in exercise price from 13 rupees, your value has gone up to what? To 15 rupees. So therefore, your incremental fair value will be 13 minus 15. That means it will be 2 rupees. That means it will be 2 rupees. Did you understand? You have to take the fair value on the date of modification minus what is the revised fair value. Vesting date for modified option is equal to same as the original option. So no change in the vesting term. Position at the end of year 2, number of employees that have left is 35. Number of employees to leave is 30. At the end of year 3, number of employees left is 28. And number of employees entitled to exercise the option is 507. And at the end of year 4, number of employees exercising the option is 500. Number of employees not exercising the option is 7. That means these options have lapsed. Compute the expenses to be recognized each year. Compute the expenses to be recognized each year and also show the journal entries. So therefore, let us come to this problem. I hope you have the question with you. So we shall proceed to solve. I'll be a little fast. I still have to cover cash settled share-based payment plans, group share-based payment plans, and share-based plans, cash settled plans with a share alternative. So there are still some more concepts to do. I may extend by about 20 to 25 minutes. Please bear with me. Okay. So now let us come to the question proper. First one. The modification is happening in which year? The modification is happening at the end of the first year. And on the date of modification, the fair value was 13. So what you did, you brought down the exercise price. The fair value went up to 15. So the modified plan has increased your fair value by 2 rupees. You will record this increase in 2 rupees over a period of the remaining how many years? Over a period of 2 years. Why? Options have a 3-year life, right? Options have a 3-year life, vesting exercised in the 4th year. So out of 3 years, 1 year has gone. So the impact of modification will be over 2 years. Original plan will continue to function. Original plan will continue to function as you had estimated. Okay. So now, computation of expense to be recognized. Computation of expense to be recognized. How do I do this? Now, original plan and modified plan. Modified plan. Now, expense to be recognized. Expense to be recognized based on what? Original plan, the basis will be the fair value at the grant date. The fair value at the grant date. Which is how much in this problem? Fair value at the grant date is rupees 14. Fair value at the grant date is rupees 14. Now, the modified plan, fair value at the date of modification. At the date of modification. DOM means date of modification. That is how much? 15 rupees. That is how much? 15 rupees. And what is the fair value of original option? Fair value of original option at the grant date. at the grant date, what is the fair value of original option? This fair value has fallen to 30. So you are giving an additional benefit of 2 rupees. What is this 2 rupees? This becomes your incremental fair value. And this incremental fair value will be recognized as an expense when? Over the next 2 years. So therefore, this is A, and B, period of expense recognition. Period of expense recognition. How will you do that? You will say this plan will continue to happen over a period of 3 years. So amortized over 3 years, the first plan. Whereas the modification, not the total, okay, not the total. Please remember, it is only this 2 rupees. This will be over the balance 2 years. So amortized over 2 years. Amortized over 2 years. Why 2 years? Because change happened at the end of year 1. Revised at year 1 end. Therefore 2 years. Therefore 2 years amortized over the remaining period. All right. So this is done, and basis this we will now have to calculate our expenses. I give you 10 seconds to just draw this, and then let us proceed with doing the question. Let us proceed with solving the problem. Okay. All right. Fine. So this is what is your basic. And now let us proceed to prepare that expense table that we always do. Expense table will be year 1. Year 1, no modification. So original plan. Original plan. Then you will have year 2. In year 2, you will be having original plan plus the modified plan. Original plan plus the modified plan. Year 3, you will again be having original plus the modified. You will again be having original plus the modified. So this is how it will happen. The original fair value of how much? 14 rupees will be year 1, year 2, year 3. The incremental fair value of 2 rupees will be over year 2 and year 3. That's it. That is how you will do the accounting. Now, let us come to the question proper. A, number of employees at year end. At year end. What is the question saying? At the end of year 1, number of employees who have left is 30. So you had 600 employees. Out of that, 30 have left. So 600 minus 30, that gives you 570. That gives you 570. And expected to leave in the future. Expected to leave in future. You are calculating expenses at the end of every year. So you need to know how many options are vesting. So I need to know expected to leave in the future. How many are expected to leave? In year 1, you expect 70 to leave. Therefore, employees expected to be eligible. Expected to be eligible is how much? 570 minus 70, that leaves you with 500. So what is the number of options? Each person is given how many options? 60 options. B, total options. Total number of options. Total number of options expected to vest at end of vesting period. At end of vesting period, how much is it? 500 into 60. So that gives you 30,000 options. That gives you 30,000 options. What is the total value of options? Total value of options is 30,000. This is original. So rupees 14. So that gives you rupees 4,20,000. That gives you 4,20,000. What is this? This is expected expenses at the end of year 3. So I will have to take only 1/3 cost, because original plan is having a life of 3 years. Original plan is having a life of 3 years. Okay, just a minute. $4,20,000 expenses for the period. This is cumulative. 4,20,000. This is the first year. So I will take only 1/3. So this will be 1,40,000 rupees. This will be 1,40,000 rupees. All right. Ambika. Sir, we always take fair value on the grant date. So increase in fair value 15 is to be compared with 14. No, Ambika. The standard is telling that you are modifying the plan because of a reduction in the fair value. So therefore, on the date of modification, you will compare it with the reduced fair value. Original plan will not change under any circumstances. So original plan 14 rupees will continue in year 2 also, in year 3 also. But the modification that is happening because of a reduction from 14 to 13 rupees. So you want to encourage your employees to exercise. So therefore, your plan is worth 13 on the date of modification. You are increasing it to 15. So what is the new benefit that you are giving? It is not 1 rupee. It is actually 2 rupees. All right. In terms of fair value, it is 2 rupees, because as on this date, you check what your option is worth. The option is worth only 13. You cannot compare 14, because in the case of employees, the fair value is determined as on the grant date. But when you're modifying that point of time, why will you modify? If it was to be 14, that may not be the scenario. You need not have to modify. But fair value went down. You want to increase your vesting of the shares in the employees. So therefore, the fair value gone down, that fair value you will compare with the revised fair value, the modified fair value, and take that, which in our case is 2 rupees. So this is Ambika from Mumbai. I hope you have understood. All right. Next, expense for the period 1,40,000. Now let us come again to the original plan. In the original plan, year 2, how many employees have left? 35. So you had 570. From there, 35 have left. So you are having 535 employees. Employees expected to leave is 30. So 535 minus 30, 505. So number of options likely to vest is 505 into 60. That is 30,300. So total value of options in this case is, total value of options is 30,300 into rupees 14. So 30,300 into 14, this gives 4,24,200. This is for entire 3 years. I will be taking only 2 years cost. So 4,24,200 into 2 by 3. So that gives you how much? 2,82,800. That gives you 2,82,800. But what is 282? It is my cumulative expense. So G will be less expenses recognized previously. Less expenses recognized previously. This was 0 the first year. Here it is rupees 1,40,000. So when you subtract this, expense for the period will be 142,800. 1,42,800. Here also it will be 1,40,000. This is what expense for the period. This is expense for the period. All right, then let us again come to the original plan. Let me finish accounting for the original plan. We shall do it like that so that you are better equipped to understand. In the third year, number of employees left is 28. So 535 minus 28, 507. Are you bothered about how many employees will leave subsequently? And the answer is no, sir, I am not bothered. So therefore, this will be not applicable, not needed. So how many employees are getting? 507. So 507 into 60. This is in whom the options have crystallized. So 507 into 60, 30,420 options. 30,420 options. So what will be your price now? 30,420 multiplied by rupees 14. Multiplied by 14. So 425, 880. 425, 880. This is expense for how many years? Entire 3 years. So proportion will be 425, 880 into 3 by 3. That is equal to rupees 425, 880. How much have you recognized previously? 2,82,800. You have recognized 282,800 over the previous 2 years. So minus 282,800. Your expense as far as original plan is concerned is 143,080. 143,080. This is your expense as far as the original plan is concerned. Now we shall look at the modification. I give you 5 seconds. Just check your answers if you are getting. Let us then proceed further. Ambika, I hope you understood why we take 13 and not 14. You check what is my fair value of the option, and thereafter you shall actually modify that. Okay. So you compare that 2 rupees, take that 2 rupees as the modification. Is the feed live? Is the feed live? Just a minute. Okay. I think the feed has started. Thank you, Kaustubh, for bringing it to my notice. Okay. Must be some technical snag. All right. I have not discussed anything. I am where we have left. Thank you for the prompt interjection. Okay. 60,600 is your cost. Uma, I will come to your question in a while. Okay. 30,300 into rupees to 6,600 is your expenses now. 60,600 into half. Why half? Because the modification has happened end of year 1. So the impact of this modification has to be spread over 2 years. Has to be spread over 2 years. So 60,000 into half. First year modification expense will be 30,300. How much have you recorded previously? That is 0. So you will record here expense of 30,300 related to modification. You will record expense. Okay, Kaustubh. Thank you. Now life. There was a problem. Now fine. Thank you, Ambika. Thank you, Kaustubh. Okay. So now 30,300 is your expenses related to the modification. This is your expenses related to the modification. And now let us proceed to the third year. All the details will be the same. 507, not concerned. So total options that will vest is 507 multiplied by 60, 30,420. So now 30,420 multiplied by incremental fair value, multiplied by incremental fair value, incremental fair value. All right. So this is what you will consider. So 30,420 into 2 by 2, 60,840, right? 60,840. How many years now? Total is 2 years, right? So the cumulative expense will be 60,840 into 2 by 2. So that is 60,840. What is recognized earlier in respect of modification? Rupees 30,300. So 60,840 minus 30,300. The expenses to be recorded for the third year with reference to the modification is 30,540. It is 30,540. So this is how you will do the modification. Now, when you're preparing your accounts, your total expense, total compensation expense for year 2 will be 142,800 plus 30,300. That is equal to 173,100. This is your total compensation expenses for year 2. For year 3, what will it be? 143,080 plus 30,540. So this will be 143,080 plus 30,540, 1,73,620. I hope this is visible. 173,620. Okay, the corner may not be so visible. Just add both of them. 143,080 plus 30,540. So the entry that you will pass year 1 is employee benefit expense account debit to SBP reserve 1,40,000. In year 2 you will pass employee benefit expense account debit to SBP reserve 1,73,100. And in the third year you will pass the entry employee benefit expense account debit to SBP reserve 1,73,620. And basis this, you will be preparing the accounts. Is it okay? Yes. All right. Now, Uma has asked a question. If there is increase in vesting period also along with change in the fair value, should we take this into consideration? Uma, increase in fair value is beneficial to the employees, so we record that. But increase in vesting period is not beneficial to the employees, so the effect of the increase in vesting period will be ignored. The impact of increase in vesting period will be ignored. However, to add on to your question, if there is increase in fair value with a decrease in vesting period, then you have to account for both the things. Then you have to account for both the aspects. Yes, but increase in vesting period is not beneficial to the employees. Look at them as standalone items. Okay. Increase in vesting period means what? I promised them options in the beginning to vest after 3 years. Today I will tell at the end of first year, no, you have to work for 5 years in total. That means provide service for another 4 years. That effect is detrimental to the employees. There may be some employees who join with the hope of getting the options, and the moment they get the options, they would like to leave the company. For them, this would be detrimental. So therefore, your effect is, answer to your question is, increase in fair value, account, increase in vesting period, ignore. But if it is increase in vesting, decrease in vesting period, increase in fair value, account for both of them, because both are beneficial to the employees. All right. So this is how you will do. Now, you will be preparing the accounts. Okay. You will be preparing the accounts. I am pressed for time, but you know how to prepare the accounts. Only one thing you have to remember, my friends, when you are preparing the account, what you will do is, you remember we used to calculate the securities premium. Yes. So now when you are calculating the securities premium, the exercise price is 120. Exercise price is 120. The fair value of the options granted, fair value of options will now be how much, my friends? It will be 14 rupees plus 2 rupees due to modification. That means it will be 16 rupees. So 136 rupees will be the total value of services received. And this you compare with nominal value of 100. So 36 rupees will be your securities premium. 36 rupees will be your securities premium. So basis this, please prepare the accounts for your assignment. Okay, I'll be sharing the Excel sheet to you today itself. So I will share it with the board of studies. They will upload it for you. Please, my sincere request, do the problem and then check the solution. We are always tempted to check the solution and then do the problem. Learning will not happen that way, my friends. Okay, so do the problem, attempt it yourself. All the solutions, I'll put the plain Excel sheet itself, the formulas, everything will come for you. So therefore, please do the problem, complete the ledger. I have done the major part. Prepare the ledger accounts, do the problem, and then you will get the sheet to check your answers. But by now, you would be confident about preparing the accounts. So please do that. Please do that. Okay. So this is the answer to this question. I have discussed all the concepts that are related to modification arising due to change in the fair value. So what do we do? Calculate the incremental fair value. Calculate the incremental fair value, and what you will do, calculate the incremental fair value, apportion that, or rather amortize that incremental fair value over the balance period of vesting. That means in our example, it was 2 years. So this is what is there for you. Now let us proceed to the next question. I will give a break once I finish modification and cancellations. This is a simple effect. So what I can do after the break, I will directly start with share appreciation rights and the remaining topics, which will not take much time. All right. So let us proceed. I'll give a break in another 15-20 minutes. Kindly bear with me. Okay. So let us come to the next part. That is, question number 2. Hinduja Limited grants 100 non-vested shares to each of its 1,000 employees that vest after 5 years of service. So initially 5 years of service. Grant date fair value of each non-vested share is 10. Based on historical employee turnover rates, Hinduja Limited estimates that 200 employees will terminate the service prior to the completion of 5th year. So I thought that 200 will go. So number of employees in whom the options are expected to vest is 800, 1000 minus 200. At the beginning of year 3, Hinduja Limited accelerates the vesting. Is this a modification? Yes, accelerates the vesting of all the awards, so that vesting occurs after 4 years of service rather than the original 5-year service period. Original 5, now it became 4. Is this a modification? Yes. Is it beneficial to the employees? Yes. As a result of acceleration, Hinduja now expects that only 150 employees will forfeit their awards. All right, forfeit means they will leave during the period and go. Options will not vest in them. Options will not vest in them. Compute the expense that the company should recognize in each of the years. So a simple problem, no need of any accounts or journal entries. It is a very, very simple problem. Let us come to the solution. I hope you have the question in front of you again. Let us now proceed to do these problems. Okay, so stop the share and come to the problems. 5 years now. Year 1, year 2, year 3. Why am I doing like this? Year 1, 2, 3, 4, and 5. Now, originally, A, number of employees expected to satisfy service condition. How many? You thought out of 1000 employees, 200 will leave. That means in 800 employees, your option will vest. Same goes for year 2 also. 1000 minus 200, that is 800. What is the number of options? Total number of options is 100 each. So number of options, 100. Number of options 100. So what is the total value of options? Value of options likely to vest. Nothing but 800 into 100 multiplied by what is the fair value grant date? 10 rupees. So 800 into 100 multiplied by rupees 10. So that will be how much? Rupees 8 lakhs. Here also it will be rupees 8 lakhs. All right. And initially the vesting period was 5 years. So vesting period initially 5 years. So proportion of expenditure, it is 1/5 for the first year, 2/5 for the second year. So F, expenditure cumulative. For the first year, 8 lakhs divided by 1 lakh, 8 lakhs divided by 5. So that will be 1,60,000. 8 lakhs into 2 by 5. This will be 3,20,000. Less expenses recognized earlier. First year, nothing, so 0. Second year, you had recognized 1,60,000 earlier. So therefore, how much you will have? Rupees 1,60,000 to be recognized for the second year as well. This is what you have estimated. Now, at the end of the second year, your options are getting modified. Your options are getting modified. What is the modification? Now, my vesting period will not be 5 years. It will now be only 4 years. It will now be only 4 years. And as a result of this, what are you now expecting? You are now expecting that only 150 will forfeit. Only 150 will forfeit. That means 1000 minus 150. That means 850 employees will now take up your shares. This is what is your estimation. Each of these 850 employees will get 100 options. So value of options will be 850 into 100 into rupees 10. That comes to how much? 8,50,000. That comes to 8,50,000. What is the vesting period now? Now the vesting period is 4 years. Change, accelerated. From 5 years, it became 4 years. So 8,50,000, 1 to 3 years have passed. So proportionate you will take is 3/4. So 8,50,000 into 3 by 4. So that gives you 6,37,500. 6,37,500. How much have you recognized earlier, my friends? You have recognized 3,20,000 as an expense. So 6,37,500 minus 3,20,000. Your expense for the third year will be 3,17,500. 3,17,500. And finally, it is again 850. Finally, it is again 850, 100. So your total fair value will remain as 8,50,000. Vesting period is 4 years, 4 by 4. So therefore, this will be 8,50,000 minus what you have recognized earlier, 637,500. 500. So when you subtract, the last year's expenses will be 2,12,500. This will be 2,12,000. Excellent. Yeah, Neha, 2,12,500. Good. Very good. Year 1, year 2, year 3, year 4. Yes. So this is the effect of accelerated vesting. This is the effect of accelerated vesting. All right. And now I give you again, just take 10 seconds quick, and let us then proceed to the next questions. Next set of questions. Relating to modification only, I have one more question for you. All right. So I hope this is clear. The next question, I just come back to this question that I had left. All right. Now, let us come to the next question. This question is relating to cancellation. Cancellation of the plan itself. That means you promised them you will give them shares. Because of some reason whatsoever, you are cancelling the plan. Because of some reason, let me first explain the theory and then we can see the problem. Okay. So cancellation. Is cancellation a modification? Yes, it is. It is a special type of modification. Remaining modifications are all what? Remaining modifications are all changes to the plan, but plan exists. And modification was only to be accounted in respect of those modifications which are beneficial to the employees. Now in this scenario, what you will do is, you have a plan. You accounted for expenses for the plan for some period, maybe 1 year, 2 years, whatever it is. And then suddenly in the middle of the year, you decide, sir, I want to cancel this plan. Can you cancel this plan? Technically, you cannot, because that would amount to a breach of contract. See, what is a stock option plan? You are entering into an agreement with your employees to give them the shares after some period and subject to fulfillment of certain performance conditions. So your employees are diligently working in the hope that they will get those shares. What you are doing as an employer is now you are taking away those benefits from them. So when you are taking away those benefits, look at what they have done, the employees, in the hope that they will get the options. They are doing better performance. If your performance condition was cost reduction or increase in profitability, the employees are sincerely working to achieve that for the company in the hope that company will grow, my growth also. Employer, that is the company, takes away those options, cancels the plan. So is this not breach of contract? It is, because grant date you promised, during the period you are cancelling. So now what the standard says, cancellation of a plan will be regarded as acceleration. Sir, why will cancellation amount to acceleration? Simple. There was a contract that has been breached. Now, because of this breach, you will have to pay them a compensation. Employees will say, sir, you cannot take the plan away like that from us. If you take it away from us, you have to compensate us. So what you will do, you will not issue them shares, but you become liable to pay a compensation. It is not so simple that you tell that I will give the shares and the next year you say I will cancel it. It's not so simple. When you cancel the plan, you are liable to give them a compensation. So you will accelerate the vesting in a manner such that all your expenses are recognized, accelerate the vesting, your expenses are recognized, the entry for employee compensation expense account debit to SBP reserve, this entry will be done for the total value. This entry will be done for the total value. Now see, the interesting part about this is what? The interesting part about this is, suppose your options are for 4 years. Suppose your options are for 4 years. You estimate that in the 4th year, 10 employees will be leaving. Suppose that is your estimate. Now, at the end of 2nd year, you cancelled. When you cancel, even those employees who you thought would leave at the end of 4 years, even those employees will be liable to receive the compensation. Okay, you will be liable to pay them the compensation. So you will accelerate the vesting. As on 2nd year you cancelled, so by 2nd year you record all the expenses. So employees benefit expenses account debit to share based payment reserve. At the 2nd year itself you record it. Now you have to pay them the compensation. Now the nature of this SBP reserve, the nature of this SBP reserve, as long as the plan was alive, this SBP reserve was in the nature of equity. This SBP reserve was in the nature of equity. But when this SBP reserve, when this plan is cancelled, you are liable to pay them a compensation. So at this point, this equity will now partake the nature of a liability. You treat it as if it is a liability. So when you pay them the compensation, the entry will be SBP reserve account debit to bank. The entry will be SBP reserve account debit to bank with the compensation amount. Sir, expenses related to compensation, that is recorded now. What I told you, you accelerate the plan. You accelerate the plan means in effect, if your plan is for 4 years, 1, 2, 3, 4. If your plan is for 4 years, and the cancellation happens at the end of the 2nd year, what you do? All 4 years expense, you book it by the end of the 2nd year. So ho gaya na, you have recorded the compensation expenses at the end of the 2nd year itself for the entire 4 years. And against this SBP reserve created, you will be paying them the liability. You will be paying them the liability of compensation. So this will now partake the nature of a liability, and you will make them you will give them the payment of compensation. Now, compensation may be more than the balance. Compensation may be less than the balance in the SBP reserve. Let us assume your SBP reserve had a balance of 10 lakhs. The compensation that you decided to pay them was 9 lakhs, for example. So when it is 9 lakhs, entry will be SBP reserve 9 lakhs to bank 9 lakhs. The balance will not go to the P&L, but you will take it to retained earnings. For the balance, it still remains an equity. You will take it to the retained earnings. But suppose 10 lakhs is the balance and you promise to pay them a compensation of 11 lakhs and you pay a compensation of 11 lakhs. You are paying more than this. So this balance of 1 lakh, where it will go, this will hit your P&L account as a loss arising due to compensation, a loss arising due to compensation. So principles of cancellation of plan, treat it as accelerated vesting. When you treat it as accelerated vesting, you will have to record all the expenses that you first estimate over the plan up to the date of cancellation, record all the expenses. And because of this breach of contract, there will be a compensation that is payable to them. Compensation up to the balance in SBP reserve, meet it out of SBP reserve. Above the SBP reserve, what is there? That will go to your profit and loss account as a loss on compensation. If it is below the SBP reserve, very rare, but if it happens, for example, now see, you cannot leave that SBP reserve hanging because now plan itself is not there. How can you keep the SBP reserve? You do a transfer between equity, SBP reserve account debit to retained earnings. So this is how you will account for cancellation of a plan. Okay, so with this background, let us now come to the next problem. Okay. Let us come to the problem. I share the screen. Yeah. Anara Fertilizers Limited issued 2000 options to its 10 directors for an exercise price of 100. The directors are required to stay with the company for the next 3 years. Fair value of the options estimated is 130. Expected number of directors to vest the option is 8. During year 2, there was a crisis in the company and management decided to cancel the scheme immediately. It was estimated further as below. Fair value of options at the time of cancellation was 90. Market price of the shares at the cancellation date was 99. There was a compensation which was paid to the directors and only 9 directors were currently in employment. At the time of cancellation of such scheme, it was agreed to pay an amount of 95 per option to each of the 9 directors. See now, I told you, you are first expecting only 8 employees will be there. But now on the date of cancellation, 9 employees are actually there. So all the 9 employees will be liable to get a compensation. So that is how you will be recording. Okay, now let us come to the problem. So how would the cancellation be recorded? Okay, so now let us treat this as an accelerated vesting, and let us do the accounting. So year 1, year 2. Expected directors to fulfill the conditions. How many directors you expect? Well, first year you thought it will be 8. Then you thought that you will cancel. So at the time of cancellation, there were 9 directors who were there. So they would be fulfilling the requirement. Fair value of options at the grant date. This is initial at the grant date. How much is that? 130. What is the number of options? Number of options for each director is 2000. Number of options for each director is 2000. So therefore, total compensation expenses, total value of options expected to vest is how much? 8 into rupees 130 into 2000 options. And this would be 9 into 130 rupees into 2000 options. So this would be how much? So 20 lakhs 80,000 you thought here. And here it will come to 23 lakhs 40,000. Now, year 1 cancellation was not there. So you will record it as you thought would happen. So the initial vesting period was 1/3. The initial vesting period was 1/3. So proportion of grant was 1/3. And you are cancelling it in year 2. So proportion of grant will be full. You will accelerate the vesting because they were working diligently for you. So therefore, that much you will recognize in full. So proportion of grant is 1/3. Year 2, it is full. So therefore, F, cumulative expenses, 20 lakh 80,000 divided by 3. First year, you will recognize 6,93,333 rupees. Second year, you are accelerating. So 23,40,000 will be recorded fully. So less expenses recognized earlier. 0. Here it is 6,93,333. So expenses for the year will be 693,333 for the first year. For the second year, it will be 1646,667. 16,46,667. All right. Is it okay? Yes. Now, this is what is going to be your picture. So what will be the journal entry in year one? Journal entry in year one will be employee compensation expenses account debit to employee compensation expenses account debit to share-based payment reserve 693,333. The second year it will be employee benefit expense account debit to share-based payment reserve 16,46,667. So I hope you have taken a note of this. At the end of year two, now you will be having SBP reserve. You will be having SBP reserve with a balance of rupees 23 lakh 40,000 credit, with a balance of 23 lakh 40,000 standing to its credit. Now let us come to the problem once again. Okay, they have given some information. What have they given? During year two, there was a crisis and management decided to cancel the scheme immediately. Okay, it was estimated further as below. What is estimated? The fair value is given now. This is a case of a reduction, a crisis. There is a fair value of option that is there. So now your directors are telling we are not in a position to give because the company is not performing well. So the fair value of the option initially was 130, that has dropped down to 90. So you are telling the employees we cannot give this to you. Instead, we will pay a compensation to you. So 95 rupees is the compensation value that is given in the last paragraph per director, and the fair value of the option as on the cancellation date is 5. So what will you do? To the extent of the difference between the fair value and the compensation, that represents the loss that will take to your profit and loss account. All right. And the balance, if any, that will be there in the share-based payment reserve will be transferred to equity. Okay. So this is a case where there is a problem in the company. The fair value has dropped down. You are giving them a higher compensation and telling them you go with this compensation because when you exercise the option, it will not be worth what it is. So you want to cancel the plan, you take these compensation amount, the difference between the two amounts, you recognize it in the P&L. So let us look at how it is done. All right. Now, in this case, treatment of cancellation compensation. Treatment of cancellation compensation. Now, here, what do you think? First one, total compensation. Total compensation on cancellation. 2,000 options multiplied by 9 directors, and per option your compensation is 95. So that gives you how much? 17,10,000. 17,10,000. This is the total compensation that you will be giving to the directors, the cash payment that you will be doing. This you compare it with fair value of options, on the date of cancellation. On the date of cancellation, because here there is a reduction in fair value. So you want to benefit the employees. You want to tell them, sir, don't take these shares. I'm giving you the cash and I want to cancel the options. So therefore, you will say 2,000 options multiplied by 9 directors multiplied by rupees 90. What is this 90? Fair value on date of cancellation. Fair value on date of cancellation, right? That is what it is. Yes or no? At the time of cancellation. Yeah. So 18,000 into 90. So 16,20,000. So what you are doing, Against option worth of 16 lakh 20, you are giving them a compensation of 17 lakh 10,000. That means you are paying them 90,000 extra. You are paying them 90,000 extra. This will be loss on compensation, loss on compensation transferred to P&L. This will be loss on compensation that will be transferred to P&L. But now the question will come, sir, balance in SBP reserve is 63 lakh 40. Against that, you will be utilizing 16 lakh 20,000, right? 90 will go in the P&L. What will I do with the balance? The balance is not the worth of the options actually. The options worth has fallen down. So that balance, you cannot write it back to the P&L. You will instead make it as a transfer between equity. You will instead make it as a transfer between equity. So I hope you understood the treatment of the cancellation compensation. Yes. And then what will be the journal entry? I will wait for 5 seconds until all of you have taken a note of this. Anybody has any doubts so far? Please drop in a couple of questions, or just saying that it is clear so far, or I'm fast or slow or whatever it is. Please drop in a comment. If there is anything, let me know. I hope you have written this. I rubbed this off. Now, the journal entry. First 2 years journal entry, you know. I don't have to tell that to you. The next period journal entries on cancellation, what you will pass? Share-based payment reserve account debit. How much? 16 lakh 20,000. What is this? This is the fair value of the options worth which you are cancelling. It is now treated as an extinguishment of a liability, because I told you the moment there is a cancellation, accelerate the vesting, record the liability and pay it in cash is equivalent to extinguishment of a liability. This is fair value of options on date of cancellation. Fair value options on date of cancellation. To bank, how much are you paying them? 17 lakh 10,000. 17 lakh 10,000. So balance 90,000. We have done the working also. This is loss on cancellation. Where you will take it, you will take this to the P&L account. This you will take it to the P&L account. All right. Thank you, Kaustubh. Next. There is still a balance in SBP reserve. It was 23 lakh 40. You have extinguished only 16 lakh 20. So 23 lakh 40 minus 16 lakh 20, that leaves you with 7 lakh 20. That represents value that you have to transfer within the equity. So the entry will be SBP reserve account debit 7 lakh 20,000 to retained earnings, to retained earnings, to retained earnings 7 lakh 20,000. Okay. Now suppose, okay, so this is what is the effect. Now suppose if the employer just cancelled the options out of his own free will, not because of a challenge or because of a crisis. Fair value of the option was maintained. So what you would do at that point of time, they would get a higher value, obviously, right? They would get a higher value. So you would debit 23 lakh 40. The compensation paid would naturally be higher to them. So therefore, the P&L figure would be a balancing figure. You would not have anything to be transferred to the retained earnings. You would not have anything to be transferred to the retained earnings. Okay. So this is everything about modifications, cancellations, and modifications in fair value, modifications in vesting period. Everything we have covered. Okay. So with this, we complete our portion relating to modifications. The topic is not yet complete. I give you 10 seconds you to just ensure that you have written. Anybody has any doubts? Ambika, Uma, Neha, Kalyani, if you have any doubts, please ask. If there is no doubt, I will just proceed further. Okay. So let us share the screen. Now, I want you guys to be doing illustration 10 by yourself. Easy it is. I have done difficult problems, slightly complex problems. I won't say difficult. You should be able to do illustration 10. 11 I have done. Illustration 8 I have done. Question 2 I have done. I want you to solve this RTP question by yourself. It is also relating to change in the fair value of the option, but the effect is here the option is changing not at the end of the year but in the middle of the year. So therefore it will not be a whole years, it will just be in fraction of years. That is the only change that is there, but it is a beautiful question. I want you to do this option. I want you to do this question by yourself. Okay, so with this we come to an end of our discussion on equity settled share based payments. We will now take a short 5-minute break. I will extend the class up to 10:30 max. Okay, so please bear with me. I have to complete the portion. When I solve the problems, it takes a little bit of time, but I hope it clarifies your doubts. Okay, so therefore take a 5-minute break and then we shall resume. Okay, the remaining part of the chapter is very easy. It won't take much time. Okay, all right. Jay? Jay? 5-minute break, please. We will meet at 9:42. Okay. All right. Okay. Just confirm if the feed is on. Yes. All right. Ambika had a query to ask, sir, is cancellation somewhat similar to reduction in vesting period? Yes. In fact, when I explained to you cancellation, I told you that you account for it as an accelerated vesting. You account for it as accelerated vesting. And what is accelerated vesting? That is nothing but reduction in your vesting period. So therefore, you are right when you have said that it is similar to reduction in vesting period. The only difference is what? In the case of cancellation, there is an accelerated vesting. For the remaining life, you record it right now on the date of cancellation, the expenses, but there is a compensation that will be paid. Why? Because that is a breach of contract. So in respect of cancellation of ESOPs, you will be having a breach of contract that happens. So this breach of contract makes the company liable to pay a compensation. So that is one additional thing that is there. Okay, so that is the only extra thing that is there. Now, yes, Ambika, why is it necessary to charge to P&L even if we have SBP reserve? Is it because of breach of contract? Yes. See, you have to show the shareholders, you have to show the users of financial statements that what you have committed is a breach. You are cancelling a plan. The implications of that plan has resulted, in our example, you paid them 95 as against the fair value on the date of the contract. So therefore, you are paying them 5 rupees extra. Why? Because as on the date of original vesting, they would have gotten the shares if the shares were valuable. You are now telling them, I'll not give you the shares. So therefore, we all know that shares normally appreciate. Yes, they are good, well-performing companies. The share values appreciate. That is why your employees are interested to invest in the shares. When you are giving them cash alternatives, ultimately cash will not fetch the amount of appreciation that equity does in real life. Of course, I'm talking about good stocks, okay, good shares. So therefore, I want to tell my users that, look, I cancelled the plan, and pursuant to this plan, this is the compensation that I had to pay to them. I paid this much excess, in our example, 5 rupees excess over the fair value at the date of cancellation. And that is the hit that I have taken to the P&L. Sir, what about the balance in the SBP reserve? You may pay above that. If your shares are well performing and you are just cancelling out of your own whims and fancies, you will definitely be paying much more than 23,40,000. Then share-based payment reserve will not be there at all. Rather, you will have a greater hit to your profit and loss. But in this case, like for example, again, I move back everywhere and come to our present scenario, which is COVID. In COVID, I tell my employees, look, the share price has fallen to such historical low levels that by the time my option vests, it will not be worthless. That means I'm telling the employees, look, when I gave you the options, I thought that the worth of the options in our example would be 130. But COVID came, the fair value of those options fell to 90. So I will tell my employees, look, in the next 2 years, I don't expect the fair value of my options to go from 90 to 130. If you are there, then it is probable that what you thought would be the growth in the market price, what you thought would be the benefits accruing to you, will not accrue. And therefore, you will be better off if you accept the cash compensation as on date. That enhanced 5 rupees that you are paying, the difference between fair value and the additional amount that you are paying, that difference is the compensation that you are giving to the employees. That is why you take it to the P&L. Uma, now, sir, as you said, value of shares can't be revalued. So we considered the fair value at grant date only. This is in the normal scenario. Yes. How can we reassess the fair value at the time of cancellation or modification? We are considering that reassessed fair value for calculating loss on compensation. See now, What we are changing is only the impact of modification and the impact of cancellation. If you look, the original fair value continues even in modification, Uma. See, in the question that we did on modification, I took 14 rupees for all the 3 years. Only for the change, that is the modification, only that part, the effect of modification, I have taken that. That does not mean I am revaluing the options. I am actually calculating the impact of those options. I am actually calculating the impact of those modifications. All right, but original plan continues. Original plan continues. There is no change to that original plan. You want your, see, even look at the scenario. If at all I had to change that, then you know what I would do? First year I would take it as 14, then I would take it as 13 over the next 2 years. Am I doing 14, 13, 13 such that at the end the fair value is 15? Have I done that? The answer is no, I have not done that. I have taken 14, 14, 14 plus 2 and 2, because as on the date of modification, at that time I will have to check what is going to be my fair value, because the fair value has dropped and you want to give the benefit. So that additional benefit, for that additional benefit computation, you are taking the revalued figure. But remember, we are keeping the original fair value constant always. So there is no question of revaluing this amount. The same is applicable for cancellation as well. I am taking the revalued amount only for the purpose of assessing the compensation that is payable. But that does not mean I am revaluing the options. As on 23rd, as on the second year, if you remember, I had calculated the 23,40,000 using which fair value? I had calculated that using fair value at the grant date itself. Are you seeing any change in this figure in the initial expenses? The answer is no, you are not. So the initial plan continues at the fair value at grant date. What I am doing is I am only recording the modifications based on the revised value. I am only calculating the compensation based on the revised value. I am nowhere altering the fair value. Nowhere am I carrying out a revaluation of my equity. If I had to calculate a revaluation of my equity, you know what would be the effect? I would credit the revaluation. I would credit my SBP reserve with the increase or debit it with the decrease. I'm not doing that. That you used to do in inter-CA when you used to measure it based on intrinsic value, because the guidance not permitted you to do it on intrinsic value. But now here you cannot follow intrinsic value. So the fair value that I have taken at the beginning continues till the end. Only the modification or the compensation, I will have to check with the fair value on the date of modification or fair value on the date of compensation, because that represents the additional benefit that I'm giving to the employees. That represents the additional benefit that I'm giving. I'm not changing the original fair value. Only the modification purposes I am recording. So therefore, it is only for modification or for compensation. I hope Uma from AP has understood this. Okay, so this is fine. Let us now come to the next important points. Not much is left now. You are having share appreciation rights. You are having share appreciation rights. I told you name of this standard is share-based payments. Name of this standard is share-based payments. So therefore, when we talk about share-based payments, it could be payment in equity shares, which is equity settled share-based payments, or it could be payment in cash based on the price of the entity shares. That could also be a payment. So therefore, that second option is known as cash settled share-based payment. In simple terms, we call it as a SAR, share appreciation rights or stock appreciation rights. Now, in the equity settled ESOPs that we had, The entry was employee compensation expenses account debit, employee compensation expenses account debit to SBP reserve. Why? Because the settlement would happen in equity. The settlement would happen in equity except for cancellation. Cancellation is a rare thing. Please keep it aside. Cancellation converts your SBP reserve into a liability for the purpose of extinguishment. But here, what you are paying is cash. And if you look at the definition of financial instruments under Ind AS 10932, so here the definition of a financial liability is a contractual obligation to deliver cash. A contractual obligation to deliver cash or a financial asset. So what are you delivering here? Here you are delivering cash pursuant to an obligation, pursuant to a contract. So therefore, this becomes a financial liability. This becomes a financial liability, and all the financial liabilities have to be remeasured at their fair value. So in the ESOPs, once the fair value is taken, you take that fair value throughout, fair value at the grant date. But in the case of SAR, this is the important distinction. In the case of SAR, it is essentially what? Whenever there is a movement in the market price, there is an increase in the market price as compared to the fair value at the grant date, that increase will be given to you in cash. That increase will be given to you in cash. Okay. It is possible that the promoters do not want to dilute their holding in the company. So at the same time, they want to keep the employees motivated. So what they tell, look, we will not give you the shares because we want our holding to remain intact, but we will give you cash based on the upward or whatever, based on the movement of the prices in the shares, based on the movement of the prices in the shares. So that is how you will be computing your liability. It is, the entry will be now employee benefit expenses account debit to SBP liability. Employee benefit expenses account debit to SBP liability. Why liability? Because the obligation here is not to deliver equity, but the obligation is to deliver cash. The obligation is to deliver cash. Therefore, it becomes a liability. It becomes a financial liability, and all financial liabilities you will study. Subject to probably certain exceptions, you will have to carry out a valuation. So therefore, at each date, you will be given the fair values in the question. You will be given the fair values in the question. So you are required to revalue that liability. Sir, if I revalue that liability, where the expense will go? It will go to employee benefit expenses. Sir, why it will go to employee benefit? Because if value increases, it represents the additional benefit that you have to give to the employees. So employee benefit expenses account debit to SBP liability. If the value decreases, sir, what will happen? If it decreases, credit employee benefit expenses again. Why, sir? Because that much less you will have to pay to your employees. So entry for the debit side, credit side will be employee benefit expenses, and the movement will happen in SBP liability account. Number one. Last is when you settle the liability, it will be SBP liability account debit to bank. It will be SBP liability account debit to bank account. Is it okay? So this is a brief introduction about cash settled share-based payment plans. Cash settled share-based payment plans. Let me come to your problems. Okay. Now see. Illustration 2, you will do yourself. I will do test your knowledge question. Okay, it is the same question, but so far I have always done illustration. So today, this problem I will take from your test your knowledge. Okay, now see. XYZ, this question has been asked in May 2018 for 10 marks. So look, all your questions on Ind AS 102, they have come for all the exams. I do not want you to lose even a single mark for this, okay? Because it is a simple chapter. You should be able to score the marks entirely. So illustration 2, I leave it to you to do. I will do a similar question that is... one second. Yeah, illustration 2, I leave it to you. I will do question number 9 from test your knowledge. Okay. Minda issued 11,000 share appreciation rights that vest immediately. Can options vest immediately? It rarely happens, but yes, it can. The management is so happy with your services that they decide to give you options that vest immediately. So you do not have to fulfill any conditions. So when this is the scenario, yeah. All right. Ambika has written, SAR is like a contingent commitment effect, fair value to P&L. So subsequent recognition is also fair valued. So we need to revalue. Yes, that is right. All right. Basically, you are restating the financial instrument, that is your SAR, at the value it actually represents to pay at the balance sheet date. That is why you restate that. Okay. So Minda issued 11,000 SARs that vest immediately. It happens. So whenever shares or SARs vest immediately, you have to recognize the liability or equity impact immediately. That is, entry will be employee benefit expenses account debit to SBP reserve or SBP liability immediately. There is no question of apportioning. There is no question of, calculating proportionate expenditure. So in your question, please read the question twice or thrice. Sometimes they will say vest immediately. Sometimes the question will say 11,000 share appreciation rights are issued that can be exercised at any time. That can be exercised at any time. That is another way of saying that they vest immediately. Basically, exercise anytime means what? You do not have to fulfill any conditions. It is already vested in you. So they will say vest immediately, directly, or they will say can be exercised anytime. So read the question twice, thrice, and then proceed with solving the problem. Okay. Now, all right. Now, using an option pricing model, this is again an option. All right. Option to receive cash. At that date, it is estimated that the fair value of the SAR is rupees 100. SAR can be exercised anytime until 31st March. So this is the words that will be given to you. All right. Now, it is expected that out of the total employees, 94% at the end of the period on 31st March X1, 91% at the end of the next year will exercise the option. So first year you think 94% will take, second year you think 91% will take. Finally, when these were vested, that is at the end of the third year, only 85% of the total employees exercised the option. Only 85% exercised the option. So fair value of SAR is given to you. X1, X2, X3, it is 132, 139 and 141. So therefore, you are required to pass the journal entries. All right. So now let us do this problem. This should not take much time. You should be able to do it quickly. All right. Now, I'll stop the sharing. Okay. Now, the SARs have already vested. So fair value at the time of vesting. Okay. So fair value at the time of vesting. Fair value at the time of vesting. What will that be? That is 11,000 into 100, right? Fair value is rupees 100. Yes or no? Fair value is rupees 100. So 11,000 into 100. This is rupees 11 lakhs. This is rupees 11 lakhs. This is vesting immediately. That means on 1st April X0 itself, it is vesting. You don't have to do any 1/3, 1/3, 1/3. Vested immediately. So 11 lakhs full entry you will pass. And then you need to calculate the movements in the fair value. So 31,320x1, 31,320x2, 31,320x3. This is your 3 years. You are given the fair value for all the 3 years. So first one will be percentage of employees expected to fulfill the conditions. It is vested immediately, but you think that it won't be exercised. All right. So therefore 94%. Then you think 91%. Finally, actually how much has been vested? 85%. Now, fair value of option or SAR, fair value of SARs. How much is it? It is given to you to be 132. Then it is given to be 139, and finally it is 141. 141. So total value of options. Total value of options. Total value of options expected to vest. Expected to vest. That is equal to how many options you have? 11,000. Total value of options, no, sorry, total value of SARs. How many SARs do you have? You have 11,000 SARs. So 11,000 SARs multiplied by, you think 94% will exercise, multiplied by rupees 132. Multiplied by rupees 132. So that gives you how much? 4 into 132. So 13,64,880. 13,64,880. What is this 13,64,880? This is the value as at 31st March. But you have already recognized 11 lakhs. You have already recognized 11 lakhs. You will recognize only the balance. So D, less recognized earlier. Recognized earlier. It will be rupees 11 lakhs. You have already recognized this. You have already recognized this. So this will be 2,64,880. This will be 2,64,880. 1st April, 11 lakhs. 31st March, 264,880 increase in value. Then you expect 91% here. So 11,000 into 91% into rupees 139. So 11,000 into 91% into 139. 13,91,390. 13,91,390. What is this? This is the last. This is the value of SARs expected to vest, 13,91,390, value as at 31st March. But how much you have recognized? You have already recognized 13,64,880. You have already recognized 13,64,880. So 13,91,390 minus 13,64,880, rupees 26,510 is the incremental expenditure that you will recognize. Then finally what has happened? 11,000 into 85% into rupees 141. So therefore 11,000 into 85% into 141, 13 lakhs 18,350. This is the actual vesting liability that is there. As against that, how much you have recognized? 13,91,390. So therefore, when you subtract 13,91,390, you will notice that 73,040 you have recognized excess. So 73,040 you have recognized excess, so you will have to reverse. So what will be your journal entries? On 1st April 20x0, when the SARs have vested, what will be the entry? Employee benefit expense account debit to SBP liability. 11 lakhs. Sir, will SAR always vest immediately? No, that is what the next question that I will discuss with you. SARs need not vest immediately. They may be having vesting conditions like we had for options. They may be having performance condition like we had for options. So the next question will immediately be vesting of the SARs. In fact, it was an RTP question that was asked. Okay, I'll be doing that just now. So now 11 lakhs. Now You thought 94% will come. So all this is done. Additional expense you have to book is 264,880. This is due to movement in the value as well as estimate. So you will pass entry on 31st March, employee benefit expenses account debit to SBP liability, 264,880. Then incremental expenditure is 26,510. So the entry will be employee benefit expense account debit to SBP liability, 26,510. On 31st March, only 85% exercised. The options, sorry, the SARs lapse thereafter. So therefore you cannot exercise. So 73,040, you had an excess liability. You cannot recognize profit in your own transaction. So I used to move from SBP reserve to retained earnings directly. It would not come in your profit and loss. But this is a liability that you have created. This is a liability that you have created. You had created excess liability. You had created liability 1391,390. But you have now seen that only 1318,350 is payable. So this is the excess liability that you have created. This is waived off. Waived off means I can say not exercised. It is your benefit. It is the benefit of the company. So the entry will be reverse. SBP liability account debit to employee benefit expenses. SBP liability to employee benefit expenses. You will credit the benefit expenses. Why? Because this represents a profit that accrues to the company on account of the liability not being exercised, on account of the liability not being exercised. And what you will do, you will settle the liability by passing the entry SBP liability account debit to cash bank, 13,18,350. The SBP liability will tally. So this is your question on SAR. Basically, you record the movement. You record the movement in the liability. What movement? Change in the fair value of the liability. That will always be given to you. That will always be given to you. Now let us proceed to the next question. That is, this is done by me. Now, this is the RTP question that Ambika has just now asked. This is the answer to that question, Ambika. All right. An entity which follows its financial year as per the calendar year grants 1,000 SARs to each of its 40 management employees as on 1st January X5. The SARs provide employees with the right to receive at the date when the rights are exercised cash equal to the appreciation in the entity's share price since the grant date. All of the rights vest on 31st December X6. So now see, grant is happening on 1st January. Vesting is happening on 31st December. So 2 years is your vesting period. So here you will again be having what? Proportionate calculation. Here you will be having proportionate calculation. Very interesting question that was given by the institute in the RTP. All right. Neha is saying that means effect of fair value we are recording as a liability in case of SARs. Exactly. It is a liability. It is a liability because it is an obligation to deliver cash. If you see, when you study financial instruments, you will come to know what is the meaning of a financial liability. It is an obligation to deliver cash. So therefore, you have to fair value it. You will have to fair value it as at each balance sheet date. As at each balance sheet date, when we do the fair valuation, we are taking the movement in the fair value to the profit and loss account. Thereby, my SAR liability is restated at each balance sheet date at the fair value at that balance sheet date. All right. This is exactly what you will study when you will do financial instruments also. Okay. There also you will be having various categories. Okay. This is one of the categories. You will be having fair valuation of equity, fair valuation of liabilities. You will be having amortized cost. All those things will be there when you study financial liabilities. Okay. But that is the subject matter of another Ind AS. But principles are the same. Principles are the same. All right. Now, let us come to the problem again. So here there is a vesting period of 2 years. So you will be doing a proportionate vesting. Management estimates that at the grant date, fair value of each SAR is rupees 11. So this will be the total expense that you think at the beginning. That expense has to be divided. That expense has to be divided. 1 by 2 for the first year, 2 by 2 for the second year. Now, it estimates that overall 10% of employees will leave during the 2-year period. The fair values of the SARs at each year end are shown below. 31st December X5 rupees 12. This is the vesting period. 31st December X6 rupees 8. This is again the vesting period. 31st December X7 vesting period is over. This is the exercising period. 31st December X8 it is 12. This is vesting period over exercise period. 10% of employees left before the end of X6. All right. Now, on 31st December 7, when the intrinsic value of each SAR was rupees 10, now you will find it confusing. Sir, 13 is there in the table and 10 is there in 31st December X7. What is this difference? That difference you can take it as at the time of settlement, it was 10, but at the time of the liabilities that are there with the company on the reporting date, it was 13. You can keep it like that. All right. Now, 6 employees exercised their options and the remaining 30 employees exercised their options at the end of X8 when the intrinsic value of each SAR was equal to the fair value of rupees 12. Okay, sorry. This is intrinsic value. That is the difference between the market price and your exercise price. The difference between the market price and exercise price. My mistake. I rectify myself. They're talking about intrinsic value. All right. Intrinsic value is difference between market price and exercise price. That can differ. That can differ. Fair value is valuation obtained through an option pricing model. See, the employee will come to you only looking at the share price. You cannot expect him to know what is going to be your you cannot expect him to know what is going to be the Black and Scholes model, what is going to be the option pricing model. He knows only one thing. Today, my share price has gone up by 10 rupees. So intrinsic value has gone up by 10 rupees. So I have to get 10 rupees as the payment towards the settlement of my SAR. That is the only thing that he knows. So that is the term intrinsic value. I correct myself. Okay. Now, when the intrinsic value of each SAR was equal to the fair value of rupees 12, how much expense and liability is to be recognized at the end of each year? Pass the necessary journal entries. Very important question. Very nice question from the institute. I want you to please pay attention to this question. I want you to please pay attention to this question. Okay. I hope you have the question. Let us stop the feed and stop the sharing and let us proceed with the solution. Let us proceed with the solution. All right. Now see, vesting period. Vesting period is 31st December X5, 31st December X6. And then you will be having exercise period. When is the exercise happening? 31st December X7, 31st December X8. Okay. I'm a little fast, but I have to complete. That is why. All right. Now, let us come to the problem. A. You are given in the problem that you expect 10% employees will leave during the 2-year period. So, number of employees expected to satisfy conditions. What is the condition? They have to be there for the 2 years. They have to be there for the 2 years. How many employees? 40 management employees, 10% expected to leave. So 40 minus 4, you are estimating that 36 employees will be there. 36 employees will be there. Thereafter, what is the fair value of the option? What is the fair value of the option? If you read the problem, you are given an entity gives the options to its employees as on 1st January X5. The SARs provide the employees with the right to receive cash equal to the appreciation in the entity share price since the grant date. The fair value of each SAR at the grant date is 12, but are you paying on the grant date? The answer is no, sir, you are not paying on the grant date. You are paying it subsequently. So I will not take the fair value as on the grant date. If you take fair value as on the grant date, 1st January X5, you will again have to do a valuation on 31st December X5 and record the incremental movement. Instead, what I will do, I will not record this. I will just take this and I will record the expenditure. I will record the entire expenditure on 31st December X5. Did you understand why I'm doing that? Earlier cases, I used to do it because it was vesting on the grant date. Here it is not vesting on the grant date. It is vesting subsequently. Even if I take the expense proportionately from here, which I should not, because that is the commencement of the grant date, that is the commencement of the offer. But suppose you do that also, what will happen? You will again have to revalue. You will again have to revalue. So no doing both those things for the reasons I have explained. I will directly take the fair value as at the end of year 1, as at the end of year 1, which happens to be how much? Which happens to be rupees 12, which happens to be rupees 12. So therefore, what is your total value of options? Total value of options or SARs. I have become so used to writing options. Total value of SARs likely to vest. 36 into 12. Into each employee gets how many options or SARs? 1000. So into 1000. Okay. So 36 employees, fair value is 12 into 1000 SARs. So that gives you how much? 4,32,000. Now, is 4,32,000 your expense for the first year? And the answer is no, it is not. Why? Because the vesting period is 2 years. The vesting period is 2 years. So therefore, cumulative proportion. What is your proportion? Proportion will be half, 1/2. So therefore, cumulative expenditure will be 4,32,000 divided by 2. So first year's expense will be 2,16,000 less recognized earlier. Now this is the first year. I have not recognized anything. So 2,16,000 will be expenses for the year. This will be expenses for the year. The second year, what is going to happen? I will have to do a revaluation again. What is the value of the option? 8. So 36 into 8 into 1000. So that gives you how much? 36 into 8 into 1000. That gives you a liability of 2,88,000. And what is the proportion? Options are vesting, na? The SARs are vesting. So 2/2. So this will be 2,88,000. How much you have recognized earlier? 2,16,000. So 2,88,000 minus 2,16,000, you will be recognizing additional expenditure of 72,000 on 31st December 20x6. You will be recognizing additional expenditure. So what will be the journal entries? 1st January, will you pass the entry? The answer is no. Why? Because the options are vesting after 2 years. So no entry on the grant date. You will rather record the first entry on 31st December for an expense amount of 1/2 based on the fair value, not at the grant date, but on the fair value as at the closing date, that is 31st December. Why closing date? Because this is not equity, this is a liability. So you will have to revalue the liability. So 4,32,000 into 1/2, your first year's expenses will be 2,16,000. Second year liability is 8, fair value. So 8, 2,88,000 total expense minus 2,16,000 earlier, 72,000. So the entry will be 31st December employee benefit expenses account debit to SBP liability 2,16,000. Then 31st December you will pass the entry again employee benefit expenses account debit to SBP liability 72,000. This is the entry that you will pass. All right. Is it okay? Now, on 31st December X7, look at the problem. Now, this is where the things become interesting. On 31st December X7, 6 employees have exercised the option. 6 employees have said, give me the cash appreciation. Give me the cash appreciation. So therefore, can I say 30 SARs, 30 employees have not yet exercised the SAR? Can I say 30 employees have not yet exercised the SAR? And the answer is yes. So in respect of the employees who have not yet exercised the SAR, can I say that it still represents a liability that I have to pay to them? And the answer is yes. So when it represents a liability that I am yet to pay to them, what will I do? I will have to fair value that liability once again. I will have to fair value that liability once again. So therefore, on 31st December, it will be 30 employees. Why 30 employees? Because 30 employees only have not exercised. 6 employees have exercised. We will see what is the entry that has to be passed for that. We will see what is the entry that has to be passed for that. Okay. Now, 30 employees, what is the fair value on 31st December X7? That is rupees 13. That is rupees 13. So 30 into rupees 13 into 1000. So your fair value of the liability is here 3,90,000. Here it is 3,90,000. Here it is 3,90,000. As against this 3,90,000, okay, I'll just halt it here with 3,90,000. We will now discuss about those employees who have exercised the options, who have exercised the SARs. How many employees have exercised? 6 employees have exercised. So here I will be writing exercising. So payment on exercising. You will be paying them based on the intrinsic value. Intrinsic value happened to be 10 rupees. Intrinsic value happened to be 10 rupees. So therefore, 6 employees into 1000 SARs into rupees 10. So how much are you paying them? You will be paying them 6 into 1000, 6,000 into 10. You will be paying them rupees 60,000. You will be paying them rupees 60,000. So therefore, the entry for this settlement will be what? The entry for this settlement will be SBP liability account debit to bank account. SBP liability to bank. But before this, you will have to bring the value to 10, right? Because you are settling them at 10. So therefore, your value 3,90,000 plus 60,000. This represents the total option value. This represents the total SAR value. Value of SARs not yet exercised plus value of SAR exercised. What is the total value of that? I'll write it here due to lack of space. I'll write it here due to lack of space. It must come below. Okay. 3,90,000 is the SAR unexercised. 60,000 is the SAR exercised. A liability of 60 is payable. You have to show this at 4,50,000. As against 4,50,000, you have recognized earlier expense of 2,88,000. So what is the additional expense that you will recognize now? 4,50,000 minus 2,88,000. You will be recognizing an expense of 1,62,000. You will be recognizing an expense of 1,62,000. So in a nutshell, what is the expense you have recognized? 2,16,000 plus 72 plus 1,62,000. So this would be the total expenses that you have recognized. 2,16,000 plus 72,000 plus 1,62,000. you would have recognized a total expense of 4,50,000. You would have recognized a total expense of 4,50,000. All right. Now, against this, you will be making a payment of 60,000. Against this, you will be making a payment of 60,000. Now you come to the last year. In the last year, 30 employees are exercising their options. 30 employees are exercising the SAR. So 30 employees, when they exercise, they will be paying, they will be getting a value of 12. They are given in the problem intrinsic value of 12 equal to the fair value. So therefore, how much they will get? 30 into rupees 12 into 1000. So they will be getting 3,60,000. They will be getting 3,60,000. As against 3,60,000, what was the liability that you had? 3,90,000. As against 360, you had a liability of 3,90,000. Don't look at this 450 now. Why, sir? Out of 450, 60 is paid off, right? 60 is paid off. So 450 minus 60, or 450 is also 2,16,000 plus 72 plus 1,62,000. Total expenses recognized is 450. Out of that, expenses recognized, liability created. So 450, out of that 60 is paid. So you will be left with how much? 3,90,000, which is this liability. As against that, you are settling the liability on 31st December X8 for only rupees 3,60,000, for only 3,60,000. So 3,60,000 minus 3,90,000, you will be getting a gain on settlement. You will be getting a gain on settlement, which you will pass during the year. Entry will be SBP liability account debit to employee benefit expenses. This is a gain on settlement, 30,000. You will credit your expenses. And finally, payoff entry will be what? SBP liability to bank, 3,60,000. The final payoff entry will be SBP liability to bank, 3,60,000. Have you understood? Yes. Did you understand the problem? I am a little fast, I know, but I have to cover only 2 more things now. Yes, I hope you have understood. Jay, thoda sa aur extend hoga, maybe 10 minutes. Okay. All right. So now I hope you guys have understood so far. 30,000 will be reversed. Why? A liability of 3,90,000 you are settling by paying 3,60,000. So entry will be SBP liability account debit to employee benefit expenses, 30,000 rupees. That is the final expense that you will recognize. So over the years, what will be the expenses? First year, 2,16,000. Second year, it is 72,000. Third year, 1,62,000. Fourth year, you are reversing 30,000. So therefore, total expenses that you would have booked and paid is 4,20,000. Total expenses booked and paid is 4,20,000 towards your SAR liability. Towards your SAR liability. All right. So this is what is done. And now let us proceed to the next part. All right. Can I get a quick confirmation that you have understood so far? Can I get a quick confirmation that you have understood so far? Ambika, Neha, Aruna, thanks a lot. Thank you so much for the appreciation. All right. And it is an initiative of the Board of Studies. Thanks to them that we are able to reach out to you. Yes. And I hope you guys are understanding. Mine tends to get a little long because of the solving of the problems. Yes. But we are almost on the closure. We are almost on the closure. Okay. So now the next item, very important and very simple also. Okay. 1 minute. SBP, that is share-based payment with cash alternative. This is quite interesting now. What is it? You are given an SAR, you are given an option to receive cash, So it would be an SAR. But along with that option, you are also given the option that at the end of the vesting period, when you want to exercise, you can tell, I do not want cash, I want equity shares. So that is also an option that is given to you. So therefore, at the end of the period, what could happen? At the end of the period, you may either get cash at your option. That means at the option of the employee, you may get cash, or instead of cash, you may get equity, or instead of cash, you may get equity. So this is known as SBP with a cash alternative. SBP, share-based payment with a cash alternative. Either settlement can happen in cash if employee requests cash, or settlement can happen in equity if employee requests equity. Now let us come to the accounting. If you look at this, it is something like a convertible debenture. My friends, you have studied convertible debentures in your intermediate, and you will understand that what is a convertible debenture. Settlement can happen at the option of the holder, either in cash on maturity or in equity on maturity. In terms of financial instruments, this becomes a compound financial instrument. You may have studied this, or you will be studying this for sure. A convertible debenture becomes a compound financial instrument. Likewise, my SBP with cash alternative. You can get cash at the end of the period, or you can get equity. Both these options exist at the option of the employee. Employee can choose. If the company is a company like Apple or Microsoft or Reliance, then obviously the employee will share, what I'll do with cash. Better you give me the shares, my price will appreciate. All right. But if it is not a good performing company, the employee will say, I do not want equity. You please give me the cash. I'm better off with the cash. So is this not similar to a convertible debenture? The answer is yes, it is very much similar. So the accounting for a convertible debenture, how we do under financial instruments, we segregate the components into an equity component and into a liability component. Similarly, we will do the segregation into an equity component and a financial liability component. Okay. If you have studied, you know how to do this. If you have not studied, I'm sure you will be taught this, because this is one of the initial discussions that you will have on financial instruments. Okay. So here SBP with cash alternative. SBP with cash alternative. Let us now look. I will explain this with a question, because if I talk without a question, it may be difficult for some of us. Okay. And I can explain better with the help of a question. All right. I want you to do this. I have done this question for you. I want you to do this examination question, which was asked in November 2019, asked for 8 marks. Please ensure that the marks vest in you when these questions come. All right. They should vest in you. Your performance should ensure that these marks vest in you. All right. Now, let us come to this question. There are 2 questions given in your study module. There are 2 questions which are given in your study module. I will be doing, one second. I will be doing the second questions. Both are similar. All right. Both are similar, but I prefer to do the second one. I can give you the journal entries also. All right. Now, this is illustration 6. Tata Industries issued a share-based option to one of its key managerial personnel, which can be exercised either in cash or in equity. And it has the following features. Number of cash settled shares. Cash settled shares means SARs. So number of SARs is 74,000 with a service condition of 3 years. So this is a SAR. Now option 2, number of equity settled shares 90,000. This is the equity option. If the employee wants cash, it will be 74,000. If he wants equity, it will be 90,000. Now conditions for the options is service condition of 3 years and a restriction to sell of 2 years. Once you get the shares, you can't sell it for 2 years. That is the restriction that is placed. Fair value of equity with a restriction of sale for 2 years is 115. With a restriction of sale for 2 years is 115. So your equity settled shares of 90,000 have a fair value of 115 at the grant date. Now, fair value at the grant date is 135. Fair value at the grant date is 135. This is the fair value of the cash settled without restrictions. Without restrictions, why do you say? Because you are getting cash. In the first case, you are getting shares with a restriction. Therefore, the fair value is less. When you get cash, you can use the cash as you want. So therefore, fair value at the grant date 135 becomes the fair value to be used for the cash settled transaction. Very much like the normal SAR that we do. Fair value for X0, X1, X2 is given to you. Pass the journal entries. Now see, what the standard wants you to do is account for this plan as if it is a liability. Account for this plan as if it is a liability, but you will also have to value the equity option. You will also have to value the equity option. There is an equity option. There is an equity option. What is the equity? That 90,000, you have the option to get the equity settled shares. So how does the standard advise you to do it? This alternative was not there in the guidance note. This is something extra that is there. This is something extra that is there for you. Okay. So now I hope you have the question, my dear friends. So I will, all right. 1 second. Okay. Just a minute. Okay. I hope you have the question. This is a study module question. 1 minute. Yeah. I need to see the question. Yes. Now, how does the standard want you to evaluate this? Please pay attention. When did you give the options? When did you give the shares? Tata issued a share-based option and equity price with a restriction for sale, fair value at the grant date. All these things are given to you. Now pay attention. 3 dates, 31st December X0, 31st December X1, 31st December X2. Okay. Yes. बस 5-10 मिनट जब 5-10 मिनट ओके बस खत्म होने आ रहा है बस थोड़ा इंपॉर्टेंट चल रहा है थोड़ा खत्म करने दो ओके ओके या ऑल राइट I have exceeded time students please my apologies for that yes those of you who are doing internship I hope you can watch it later on those of you who are not doing internship who have completed or whatever be the reasons you can watch it but please watch I will be sharing this with you all right it is there on the YouTube please do see it okay this is the last part and then you will be able to do it okay last technical part then the group share based payment is very simple that is just 2 minutes okay now fair value of a share with a restricted clause fair value of share with restrictions what is the restrictions to sell what is the value of that rupees 115 value of that is rupees 115 under this how many shares are allotted you would be getting 90,000 shares if you follow this you would be getting 90,000 shares if you follow this therefore fair value of shares allotted will be how much 90,000 into 115 that is equal to rupees 1,03,50,000 1,03,50,000 now if You don't go for the share, but if you go for the SAR, then fair value of share at grant date, that is rupees 135. And how many SARs are allotted? Number of SARs allotted is 74,000. Therefore, fair value of SARs is equal to 74,000 into 135. That is equal to how much? Rupees 99 lakhs 90,000. That is equal to 99 lakhs 90,000 rupees. Now you see, the standard tells you if you were to get equity, the fair value of that is 1 crore 3 lakh 50,000. If you were to get the SAR, that is the SAR, the fair value on the grant date is 99 lakhs 90,000. If you opt for equity, you get 1 crore 3 lakh 50. If you opt for cash, 99 lakh 90. So the standard tells you 99 lakh 90,000 will be treated as a SAR liability. 99 lakh 90,000 will be treated as a SAR liability. The difference between 1 crore 3 lakh 50 and 99 lakh 90,000 will be treated as a equity component. Therefore, equity component is equal to 1 crore 3 lakhs 50,000, 1 crore 3 lakh 50,000 minus 99 lakh 90,000. So this is equal to 3 lakh 60,000. So what will be your journal entry that will be passed? Employee benefit expenses account debit to SBP reserve to SBP liability. To SBP reserve to SBP liability. Sir, both of them? Yes, both of them, because you are giving option for equity also. You are giving option for cash also. You are giving both the options. But wait a minute. When is my option actually vesting? My option is vesting over a period of 3 years. My options are vesting over a period of 3 years. So I cannot recognize this entry immediately. I will have to spread it over a period of 3 years. Now what the standard tells, once you have done this, 3,60,000 equity component, you will be spreading it on a straight line basis over the vesting period. So what is my vesting period? 3 years. So 1,20,000, 1,20,000, 1,20,000, you will vest over on a straight line basis over the 3 years. And this SAR liability, this SAR liability, you will take it as if it is a SAR option, vest it over 3 years using the fair values that you are given. Fair value 138, 140, 147 you are given. All right. So now a quick accounting will be done for the SAR. 3,60,000 equity component, divide it equally. All right. So now number of options is 74,000. 74,000 vesting. Fair value at year end. Fair value at year end is how much? 138, 140, 147. Total fair value. When you multiply 74,000 into 138, 1 crore 2 lakh 12,000. Here it will be 1 crore 3 lakhs 60,000, and finally it will be 1 crore 8 lakhs 70,000. So vesting over 3 years, 1/3, 2/3, 3/3, cumulative expense will be how much? 34 lakh 4,000. Here it will be 69 lakh 6,667, and finally it will be 1 crore 8 lakh 78,000. 1 crore 8 lakh 78,000. What is recognized before? You subtract 34 lakh 4, 69 lakh 6,667. So this, when you subtract, less recognized earlier. So this, when you subtract 34 lakh 4,000, here you get 35,02,667, and finally you get 39,71,333. What is this? This is expense relating to the SAR, whereas here you will have expense relating to the equity on a straight line basis. 1,20,000, 1,20,000, 1,20,000. So total compensation expenses will be 35,24,000. Here it will be 36,22,667. Here it will be 40,91,333. So your journal entry will be employee compensation expense account debit 35 lakh 24 to SBP liability 34 lakh 4 to SBP reserve 1 lakh 20. Likewise, for these two, you will pass the entries. If you choose a cash settlement, the entry will be SBP liability account debit 1 crore 8,78,000 to cash bank 1 crore 8,78,000. What will you do with the SBP reserve? You will transfer it to retained earnings. You will transfer it to retained earnings. And if you opt for equity alternative, even then the liability has to be settled, right? Because that is an option. So when you opt for equity, the entry will be SBP liability debit 1 crore 8,78,000, SBP reserve account debit 3,60,000 to equity share capital account 1 crore 12,38,000. This is the entry that you will pass. And last 1 minute I will be taking to discuss group share based payments. All right. In this case, let us assume, for example, Reliance Industries Limited has a subsidiary Jio. All right. For example, hypothetical. All right. Now, reality it does, but the example that I am discussing is a hypothetical one. Jio wants to give a ESOP plan to its employees. So Jio will tell, I will give you my shares. Employees will say, sir, your shares are not listed. What I will do with your shares? They won't be of any use to me. So then Reliance Industries will tell, all right, I will give my shares to you. You provide services to Jio. So what is the nature of this? Reliance Industries is giving as if money to Jio, and Jio is settling the ESOP. Who is receiving services from the employees? Jio is receiving. So entry will be in the books of Jio, employee benefit expense account debit. This is in the books of Reliance Jio, which I would call as the subsidiary. In the case of the holding company, that is in our example, Reliance Industries Limited, you will be crediting equity share capital. You will be crediting equity because Reliance is issuing its equity. Can Reliance debit employee benefit expense? Answer is no. Why? Because employees are giving services to Jio. Can Jio credit equity share capital? Answer is no. Why? Because Reliance is issuing its shares, Jio is not issuing its shares. So what is the substance of this transaction? Substance is Reliance is making an investment in Jio. Jio is later on passing on the benefit to the employees. So in this case, the entry that Reliance will pass is investment in subsidiary account debit. Substance is it is increasing its investment. And what is the substance for Jio? It is getting a capital contribution from the parent. So entry will be to capital contribution from parent. This is the entry that will be passed. All right. When you consolidate the accounts, capital contribution in subsidiary will cancel off each other. Sir, can opposite happen? Yes, it can happen. All right. Last half a minute. I am having holding company H Limited subsidiary. Now, my employees of H Limited, are providing services. H Limited is a non-traded entity. So therefore, it tells we will give you shares of S. So S Limited will give the shares to the employees of H Limited. So substance of the transaction is what? H Limited, S Limited, services received by H. employees benefit expense debit. And who is issuing the shares? S Limited is issuing the shares. So to equity share capital. What is the substance? When does subsidiary make payment to holding? Only when there is a distribution of dividend income received from the subsidiary. This dividend income received from the subsidiary would represent a dividend income received from the subsidiary to dividend income received from the subsidiary. This dividend income received from the subsidiary would represent a dividend income received from the subsidiary to dividend income received from the subsidiary. कितने टाइम से म्यूट पे हूं मैं? अच्छा अच्छा, okay. So H Limited is receiving the benefit, so employee benefit expense. The substance of the transaction is S is giving dividend to H, which it is passing on to employees. So S Limited will pass dividend to parent account debit. That means it is a distribution. Actually it is a distribution to the parent. For H Limited it would represent a dividend income. So employee benefit expense account debit to dividend income received from the subsidiary. This dividend income and dividend to parent, they would be cancelled when we consolidate the accounts, all right. So after this you are left with only disclosures which are theoretical. I will be sharing the entire theoretical PPT and this Excel sheet with you. Kindly go through that, and thank you so much for a patient hearing, and hope to meet you day after tomorrow once again with a new standard, that is Ind AS 12 on income taxes. Okay, please revise, please check. All right, thank you sir. Mridula, thank you for the compliments. Aruna, thank you for the compliments. And Neha, Kaustubh, all of you, thank you so much. Okay, so see you guys on Friday morning with Ind AS 12 on income taxes. Okay, Jay.